Dear colleagues, I'm happy to welcome you to the workshop on inflation targeting in emerging markets. This is an extremely important subject, especially now that the world is recovering from the coronavirus shocks. The inflation targeting framework was first introduced about 3 decades ago. Today, it has become an integral part of monetary policy in 41 countries. Inflation targeting has proved its effectiveness, and I'm glad that Ukraine is among those countries. The COVID-19 crisis proved that the NBU had done its homework and got prepared. It was probably the first crisis in Ukraine with no dramatic currency depreciation, bank runs, or financial system collapse. This gave us enough flexibility to use our policy instruments to support the economic recovery. We slashed the key policy rate to its historical minimum. In addition, we introduced non-conventional policy measures to help businesses stay on track. And the NBU managed to hit inflation target with extreme accuracy in December last year, exactly 5%. However, we all know that inflation targeting is not about celebrating the accuracy with which inflation hits the target. Inflation targeting is about taking a forward-looking approach. Today, we observe a new surge in global inflation. It seems that it becomes threatening even for the advanced economies. The NBU was among the first central banks to launch the cycle of monetary policy tightening. We are relying on forward guidance to assure market participants that we are ready to make hawkish decisions to tame soaring inflation. As a result, we now see how inflation is breaking its upward trend. Inflation is expected to get back to the target next year. Our monetary policy frameworks and instruments must be on the front line in combating new threats. Today, we meet at this workshop not only to praise ourselves for the work done, but also to make a confession that we do realize our mistakes and draw lessons for future. I'm looking forward to hearing your presentations and having a fruitful discussion. Thank you. Have a fruitful day.
Dear Governor, thank you very much for this insightful opening remarks. Dear colleagues, let me present our keynote speaker, David Vavra. David Vavra is a good friend of the National Bank of Ukraine. He is the person who helped us to introduce inflation targeting, and actually he started to do that since the end of 2004. Well, he spent, I suppose, 10, 12 years in order to prepare the National Bank of Ukraine for the introduction of inflation targeting. Definitely, he also helped many other central banks around the world, dozens of them. And we are very happy that David agreed to join our today's workshop with his lecture on inflation targeting. And David, please, the floor is yours. We are looking forward to hear your many other things.
Dear Sergey, thank you very nice for the very nice words. Dear Mr. Governor, dear guests, I'm very honored that I could give this keynote speech today at today's inflation targeting workshop organized by the National Bank of Ukraine. And I will start by uploading my presentation. They will guide me through the speech. I guess everyone can see the presentation mode right now. All right, so in my speech today, I would like to share with you a few thoughts about the continued relevance of inflation targeting, or irrelevance as you wish, as a coherent monetary policy regime. Inflation targeting has a track record of about 30 years in advanced economies and about 25 years in emerging market economies. And during this period, it has been repeatedly cast as the savior of nominal stability in these countries, a villain exacerbating world crisis, or just a bystander that happens to reap benefits of broader macroeconomic trends. Its original simple paradigm of one transparent target and focus on that inflation target has been endlessly modified. And if anything, the speed of these modifications has increased in recent years. In fact, it raises doubts whether we're still speaking about the same inflation targeting regime today as we did, say, back in 2006 or even earlier. The name itself, inflation targeting, attracts actually surprisingly little attention over the past few years. In fact, I have not been able to find any good surveys about inflation targeting practices since the National Bank of survey in 2018. And this may actually corroborate the topic of today's inflation. Today, advantage inflation targeting. Still, trademark wise, I see explanation. First is that today, through these endless modifications, inflation targeting has become understood as a loose collection of proud from that. If you are a central bank that wants to have exchange rate, it's very difficult to say you do something else unless you get inflation targeting. Second, the IT trademark actually gives probably some sense of credibility to what the particular central bank is doing. And credibility is indeed vital for inflation targeting. Why? Because it loosens the link between expectations. And if it succeeds in that, then inflation expectations become an effective shock absorber and reducing macroeconomic volatility. However, herein lies the dilemma. The dilemma is that while credibility opens room for maneuver, for policy maneuvering, it is simultaneously gained by limiting our own choices. That's how credibility is gained, at least in inflation targeting regimes. So that is a dilemma that central banks have to resolve if they think about implementing and modifying this regime. In principle, just to illustrate what I'm talking about, inflation targeting should work as follows. We live in a world where we do not believe in we believe in long-term nominal neutrality, and under such a paradigm, it makes sense to give independence to central banks. Now, if we give them institutional operational independence, the central banks can constrain their own choices. They can focus just on inflation target and a very strict set of policies. And if they succeed in that, they may actually gain credibility by, as I said, by severing its room for money. And then with the credibility comes, as I said, the coupling of expectations from actual inflation. Expectations will become effective absorber of shocks, And then, of course, for that all to work, we need to be transparent about what we're doing to keep inflation expectations anchored, which then calls. And with that transparency, as long as policies are so transparent, we give credence to the institutional operational independence. It makes all sense together. However, surely we can do better. A potential to use the credibility of once gained in other ways. We've seen it in recent years quite often that we could pursue fiscal policy instead, or we can help fiscal policy in many ways. We see central bank trying to point of view. So maybe central banks may not be as institutional. There's no need for central banks to be institutionally as independent as we thought at the beginning. We see central banks being independence being under attack from many countries, or at least having fiscal considerations in many countries, from Australia to Ghana to Turkey to the Czech Republic. So maybe once the credibility is gained, we don't need this political element here. And once we don't have this element here, maybe we don't. And we have balance sheet policies in mind. Maybe we don't need so much accountability. Maybe we can fudge things a bit, as central banks used to decades ago. And we could still preserve what we need most. And what we need most is this virtuous circle between credibility and anchored inflation expectation. As long as we have that, as long as that circle works, we don't need these other elements. Once credibility is gained, maybe. At least that's the hope, I think. And the question is whether that's really happening. So the question is, asking in this presentation is, have we got enough should I be answering the questions when I see them, or shall I continue? Because I see just on the panel there's a question. Oh, would it be possible to get the presentation files? I guess it's general. So yes, of course you will get the presentation. All right, so we see quite dispersion in terms of the inflation outcomes among the countries, at least emerging market economies, and yet we see the recent period a dramatic surge in inflation. Real interest rates are historically low, both in advanced IT years as well as emerging market IT years. So perhaps my question about credibility is relevant. Now, there are a lot of measures of credibility we can look at, but the simplest one is, of course, some kind of a metric that will work through a metric that will compare this inflation outcomes with the target. So one of the conventional metrics will give you a picture like this, which actually shows that, maybe surprisingly to many, that the credibility, at least for emerging markets, economy, IT years, is relatively high, actually still historically highest, or close to historic highs. Maybe not so much for emerging markets, for advanced economies, but at least for emerging markets, it's actually quite high. I guess this is an interesting thing. And And we can, however, if we look at dispersion of that credibility over at least for the emerging market economies, we really see that this is not a homogeneous group anymore. Emerging market IPOs is composed of today of a large bunch of central banks, and if we look at their inflation target performance, we see really a huge difference, as this chart shows, from basically zero. Zero means, in this chart, zero means zero credibility, and one means perfect credibility. And the formula that I've used is here. This chart shows several interesting episodes that may be worth looking at. Well, of course, the current episodes is what's of interest, not only today, but today, because we will have a panel dealing with later on, dealing with the policy responses to the current inflation surge and the COVID. And of course, these are topics that I will touch upon lightly during my speech as well. So what is interesting about today's situation is the extent to what it is similar to the situation before the global financial crisis. So this is I think this period before 2008, from 2007 to 2008, is actually an interesting period to look at, because we see the credibility of both emerging market and advanced economies inflation targeters dramatically declining during that period. And we're not quite seeing the same, at least not for emerging markets this day, but it's an interesting period because it shares certain similarities. Well, first of all, we see that oil and food prices are today up relative to the beginning of the COVID crisis by about the same extent as they were before the onset of the global financial crisis relative to the beginning of 2007. But this is what I'm using as normalized, the beginning of 2007 in the first period and March 2020 in the second period. And I'm just comparing them. The first chart on this top panel is probably easy to explain. The others do the same for inflation rates, real interest rates, and nominal interest rates, except that they show separately advanced economies and emerging market economies, and the legends themselves, I hope, are self-explanatory. So a lot of striking similarities between both episodes in 2007 and 2020. There are, of course, differences too. Well, one of them is that, as we can see, inflation in emerging market economies this time is lower. This inflation surge is lower than it was back in 2007, at least by this time of the development, of the crisis development. And while you also see that the emerging market central banks are slower with hiking nominal interest rates than they were back in 2007. That's the difference between the green line. Green line here shows the 2007 emerging markets, whereas emerging markets red. Emerging market 2020 is the red line here, and here in this chart. So we're comparing green and red. Now, of course, the biggest difference between these episodes is that whereas in 2007, the crisis, the output crisis, we could call it, came after the surge in oil and food prices, or oil and food prices. This time was there around firstly, so which is a difference that we have with inflation in emerging market ITers compared to those that are and the interest rate reaction that we're seeing here today. But still, is that commensurate? What will happen? How does it develop? I will leave that for the panel later on today. This is a very simple backward real interest rate, the simplest possible measure. Right? Just no ex ante, just ex post. Year-on-year inflation. All right. Good. So the question here is: can IT be an effective absorber to such shocks? Well, there is evidence. Generally, I don't want to go through literature review, and I don't think we'll get us too far. But one of the conclusions from literature is that if IT matters to macroeconomic volatility at all, there's a lot of doubts, a lot of pros and cons in the press papers. It's hard targeting. By hard targeting, here in many of the papers, they refer to very close exposed hitting of the inflation target. That's what's often called hard targeting. So hard targeting and high credibility in the simplest measure, using the similar measure that I was using before today, seem to matter empirically for good macroeconomic volatility performance of inflation targeting regimes. So, and to illustrate, so that's why I'm asking the questions I'm asking, and looking at credibility and characterization of inflation targeting regimes is therefore important. Now, to illustrate that point, I hadn't picked here, just for illustration, 3 economies, and I don't want to draw too far conclusions, just an illustration from how monetary policy transmitted in 3 COVID monetary policy transmitted in 3 economies. Czech Republic, I would say a long time inflation targeter with more than 25 years. Well, next year's maybe 25 years experience of inflation targeting. With Ukraine, which is 5 year, just celebrated 5 years of inflation targeting, and Egypt, which is let's say not an inflation targeting country yet, but an aspiring inflation target. And here we see what I'm trying to do here is I'm taking a change in the policy rate, and I am comparing it to what happened with the exchange rate, 1-year and 10-year government bonds in the period between January and September 2020. And what I'm also trying to do here in these charts is that not actual changes in exchange rates and nominal interest rates and key policy rates, but those that I'm trying to isolate the unexpected movements. So this is the unexpected, let's say, COVID shock related movement in policy rates and exchange rates. We can discuss later how I exactly did it. For instance, Czech Republic and Ukraine, the central banks publish interest rate trajectory expected, that they expect at the beginning of the year. But I can discuss the details of the construction later on. What is important to say is that the qualitative argument do not matter so in other words, even if I use actual changes in interest rates and exchange rates, you would get the same qualitative picture. Now, what's interesting in this picture? Well, 3 things, I believe. One is that while all of them cut interest rates relative to what was expected, and also in reality, they all cut interest rates substantially during that period of March to September 2020. These are the blue lines, these are the cuts. Only Czech Republic and Ukraine's currencies depreciated following the cuts. Egypt actually appreciated Egyptian pound. Now, the second interesting thing to note is that while the 1-year government bond decline was almost 1-on-1 with the Czech case, it was much less so for Egypt and Ukraine. And in fact, the third thing, if we look at long-term government bonds in Egypt, we actually see that during the same period of 6 months, it actually rose and not declined, as for instance in the Czech Republic. It stayed flat in Ukrainian case. So you do see in this just illustrative example that some kind of established credibility and pattern may matter for IT being an effective shock absorber. It may matter for the effectiveness of transmission, although this is of course by no means meant as any kind of conclusive evidence or research on the subject. So I'm back at one of my key questions, and that is, have we got enough credibility to stop the suffering? Well, I looked at credibility so far through a very simple so it's a very simple optic, right? I just looked at inflation target and inflation as such and compared the two. Now, And the subtle point I'm trying to make is that if a central bank declares itself inflation targeter, it may not actually get all these attributes that provide us credibility, unless they start severing and limiting their choices. This is one of the leitmotifs of my speech. So, however, how do we go about finding out, or how do I, by personal experience, go about when I look at a central bank, whether I think it's doing sufficient work in terms of establishing its credibility and inflation targeting credentials that could then be used for in various ways? Well, it's not that easy, it turns out. Of course, what people do, or I could do sometimes as well, I can look at all the main pillars that inflation targeting is built on, and I could examine qualitatively how the central bank, particular central bank, works in strengthening them, and I could then draw conclusions about whether this is just a self-declared inflation targeter, or if it's a central bank that is really building, working hard in order to establish its credibility. Now, we all know the drill. We all know these elements. There's a medium-term inflation target. There's operational independence from fiscal. There is interest-based operational framework, flexible exchange rate, policy driven by a forecasting system, forward-looking policy, and of course, transparent communications and accountability. Variously defined, variously characterized, and we can go one by one. However, with my practical experience, it's not that useful. It's very difficult to actually draw some unambiguous conclusions from such work. And I'll show you a few examples just to illustrate why. Well, first, let's say medium-term inflation target. The medium inflation target, of course, and I already discussed the simplest measure of credibility that works just with this simple term. Is there a medium-term inflation target? Is it being changed or is it not? But look at the previous charts. Look at this period where credibility plummeted in both actually emerging market as well as advanced economies. The same picture that you saw before. Let's look at this period. So this is a period where inflation, especially in emerging market economies, was running very high. Now, advanced economies were having a different problem. The inflation was running just too low. It was just, this is again, inflation difference, the difference between inflation and inflation target. However, look at what was happening to the target. While the target in advanced economies was pretty much flat, emerging markets during this period were on average raising inflation targets. Well, presumably because they were facing this inflation surge and they didn't know what to do about it, so they simply increased inflation target. And surely that is not the way inflation targeting should behave. So basically, simple metrics like this one does not really capture the essence of inflation targeting. In other words, doesn't capture the fact that while you can change inflation target, you should not do it under pressure, because then, of course, it won't work in stabilizing expectations and then credibility. So I can continue like that. Operational independence from fiscal. Well, I already touched upon the subject, and we see that ever more responsibility is being pushed to central banks. Okay, it's not just countercyclical policies, but structural policies and debt. And often while many keep saying about this being temporary, but many such balance sheet policies have been here for more than a decade now, and some of them are here to stay, and others have not very clear exit strategies. Just one case in point: Australia. Australia was committed to actually keeping government bonds at 0.1 yields, a particular government bond yield at 0.1. This was its target. I mean, not in addition to inflation target. And this was a temporary policy that was meant to help government finance the COVID-related crisis policy. So you see Australia as an example of a very well-established inflation target economy, having a lot of fiscal concerns in mind. And yet here, they actually dismantled it months ago because they were under such pressure, they couldn't keep it. And they simply, as you see, the yields the government yields, this bond that was meant to be, whose yield was meant to be 0.1, just shot up and skyrocketed, which, you know, is basically a performance of any kind of emerging market economy was trying to keep the exchange rate fixed or trying to manipulate something for some period of time, and it doesn't work. Coming from the Czech Republic, I have some experience with that. So you see, what kind of conclusions we draw from this? Is it that Australia is no longer a credible inflation targeter, or because they have too many fiscal concerns and they cannot handle its commitments towards the financial, towards the operational framework? I don't know. I wouldn't go that far. So it's not very useful. Policy driven by a forecasting system. Again, something that we all know the drill. We know that inflation targeting is in fact inflation forecast targeting. For that to happen, we need to put staff in the driving seat of policy, so that the policy becomes systematic. And this good systematic policy is such policy that reacts today to possible shocks in the future. And because that involves a lot of uncertainty, you react to something that you are not seeing. This is the essence of inflation forecast targeting. Reacting today to something that you're not seeing. It's of course very difficult, and psychologically it's also very, very difficult for anyone. So the forecasting systems that inflation targeting central banks have been building over these decades are designed in a way to help policymakers make these choices. So this is the drill. We all know that. However, how do you actually investigate that in practice? Now, the truth is that such examples of reacting today to possible shocks in the future are extremely rare. Okay, I'll just give you one of them. The Czech Republic cutting. This is inflation profile. As you see in 2008, inflation was running historically very high, well above the target. Yet the central bank actually cut interest rates, and it cut interest rates because it was seeing the weaknesses in the world economy, and the cut rates while ECB were raised. So, in other words, we were better prepared for the oncoming global financial crisis than other central banks, because we began cutting the interest rates earlier ahead of others. So, okay, that's brave, that is preemptive, that's a very nice example. The problem is I use such examples that I can show. And if you look at the Czech Republic today, you see actually the opposite, right? What you see today is you see inflation, the target has been above the target, and for quite some time it was also above the tolerance range, which runs from 1 to 3. But you see the nominal interest rate didn't really, were not really being raised in much of a preemptive manner. And most recently, of course, interest rates waited after inflation really shot up before they were being raised. So again, this was nothing that, a preemptive policy would have probably looked differently, right? It probably meant that the Czech Republic begins tightening early this year or maybe a year ago. That did not happen. So again, does it mean the Czech Republic is not a good inflation targeter? I don't think so. But again, I wouldn't draw too many conclusions from such analysis. Okay, transparent communications. That's something that in between. Yeah, I think we can learn a lot about central banks through the optics of how they communicate and what they actually disclose. I think that works reasonably well, but of course, again, it depends. So the virtue of inflation targeting is that it shifts the attention away from the target achievement as such. Explanations. You need to explain. If you miss things, you need to explain. There is something you need to be really honest, because people observe what you do and observe what you say. And if it doesn't match over a long period of time, you don't establish, you don't succeed, you don't establish credibility. So, yeah, but again, you should not take it too automatic. And I'll give you an example. So, example is the Czech Republic. Okay, so this is our inflation barometer. This is the Czech National Bank's inflation barometer. Now, as you can see, this is the normal barometer that has been there for, I don't know, 15 years. And the last inflation reading was close to 6%, which clearly exceeded the capacities of the barometer, right? This became the laughing stock of the internet, of course, and surely dented Czech National Bank's credibility. And Czech National Bank was simply untouchable in terms of its credibility for the most of what I can remember, last, say, 10 years at least. Now, this was in major newspapers, and of course, they immediately corrected that. So this is the chart as you see it now. But there was so is this correction? Will this correction reflect changes in what central bank is doing, or is it just a way of saying, oh, fudging things? Oh, no, it's business as usual. Don't worry, that's normal. Okay. I don't know. I can't say, of course, but this is how the communication and transparency works. So it's too early to tell, and in most cases, it's hard to really say. Of course, if the central banks, for instance, like the Ukrainian central bank or the Czech National Bank, publish an interest rate trajectory, expected policy rate trajectory, as I said, Ukrainians and Czechs do, then that can tell you a lot about how serious inflation targeted the particular central bank is. Right. So sorry. Now, so I'm back to these 6 pillars of inflation targeting, and I am left with the 2 last ones, which actually, for me, are the most important ones, or at least not maybe most important is not the right word, but at least most telling. I find them most telling about the nature of the inflation targeting regimes, in individual central banks. And I have them together here because, in fact, they are linked, at least the way I understand it. And I have an example here, what I mean by that. Well, this is a Ukrainian interest rates, the orange one. See 2 periods here. Is a period where it's changing, it became for after that. And you see the marked change in the volatility of short-term interest rate. So the exchange rate anchor simply, and we see it in other countries as well. So the exchange rate anchor actually is characterized by high short-term interest rate volatility. And that can be easily observed in most cases. Whereas inflation targeting has short-term interest rate volatility contained, and instead interest rate moves in kind of predictable longer-term cycles or medium-term cycles. And that is relatively easy to detect. Now, the other interesting observation is that, and why this interest rate and exchange rate pillars are linked together, is that if you, it's like, again, this is Ukrainian exchange rate chart. As you see, in the period where this first part, this period is a period where exchange rate was an anchor, and this is followed by a period where inflation became an anchor. As you can see, despite exchange rate being an anchor for, say, almost 20 years in Ukraine, the exchange rate moved quite a lot. On average, depreciated 40%. Whereas since then, since 2016, 2022, exchange rate has a lot of short-term volatility. But if we're a little longer-term volatility, the exchange rate is somewhat weaker today, I think, than it was at the beginning of 2016. And again, we see that pattern all over the place, and it's easy to check. So in other words, we can see that the short-term volatility, you can look at short-term volatility of interest rates. You can look at the long-term volatility of exchange rate and short-term volatility of exchange rate. And you learn a lot, at least in my experience, you learn a lot about what the regime looks like and what its underpinnings are. It may be a bit narrow view, but you can find, from experience, you can find a lot. If you look at it, just to show you some broader perspective of these observations, here you see the long-term exchange rate volatility, standard error of 5-year exchange rate change measured over from say 2004 to 2021, and indeed you see that the countries that throughout most of this period were had exchange as an anchor, be it Azerbaijan, Kazakhstan, or Russia before 2014. They have very high, in fact, long-term exchange rate volatility, whereas countries that adhered to inflation targeting was a more short-term flexibility, had much more stable exchange rates over that period. And again, with this, I think this conclusion holds more broadly than I just selected a few countries from the list. When I speak about exchange rate volatility, of course, I do not mean this, and I Hakan will forgive me. Through the thresholds, make it impossible for producers to price their products. There was a quote that got viral. When I got into the elevator, the dollar was 11.55. When I got out, it was 12.15. So this is not the short-term volatility of exchange that I'm talking about. Just to illustrate, here is an example of Azerbaijan in the Manat. We see that, say, from 2014 to, say, 2017, the exchange rate has moved by 35%. Interestingly, over the same period, Australia's exchange rate maybe not the same period, but Australia's exchange rate, the Australian dollar exchange rate also moved by 35%, but up and down. Whereas the Manat moved only in one direction. So you're not only looking at the magnitude of the exchange rate change, but also the direction. Countries that are not pursuing inflation targeting or not very sincere about it tend to have the directions only one way. And it's quite easy to spot. And I can have other examples, other countries' examples too. This is a more. Why is that important? Well, this chart shows you a more comprehensive evidence between long-term exchange rate volatility, which is on the y-axis here, and standard error of short-term interest rates here on the horizontal axis. So you see that indeed, over time it's kind of correlated, and you see various countries' points identified here. So this is why I said at the beginning that for me, these two are very important things to look at when I try to see the credentials, the inflation-related credentials of any monetary policy regime. Why is that important? Well, it's important because it turns out that why is exchange rate volatility important? Long-term exchange volatility important? Well, because it turns out that there's long-term exchange rate volatility that is associated with high inflation volatility, just here in this chart, as well as with output volatility. So if you will look at the short-term exchange rate volatility, you would not see such patterns. So again, so not only do we learn a lot about the regime itself when we look at long-term exchange rate volatility, but we're also looking at something important for macroeconomic volatility here. Ukraine is not here because, as my sample is from 2004, Ukraine is actually somewhere here outside the bounds, and it would press, the picture would not look very, it's too compressed. That's why Ukraine is not here. If there's a question, actually, I see a question here. Okay. Right. So this is sorry, there's a little sidetrack. Okay. So long-term exchange rate volatility is actually, I believe, associated with a lot of macroeconomic volatility, and we can learn from it a lot. Now here, just to show you the opposite figure, just as an illustration, I construct here a measure of exchange rate flexibility. This is kind of short-term exchange rate flexibility. And I measure it against the same metric here. That is a standard error of a one-year change in GDP. So it's basically the same figure as here on the y-axis, except that on the x-axis, on the horizontal axis, except that on the vertical axis, here I have a long-term change in the exchange rate, and here I have a short-term change in the exchange rate. So you see that this pattern that we see here actually disappears and is reversed, in fact. So countries that have more short-term exchange rate flexibility, like here, say Poland, Australia, as an example, tend to have lower GDP GDP volatility, at least empirically, and associate there's a kind of a correlations, not causality necessarily. And here I also show the movement of Ukraine from 2004 to from when I computed from the end of 2015. I guess I'm close to close my speech, and one of the motivations was of trying to define what we believe about what is inflation targeting still means. Is it still relevant? And I don't have a good answer for it. As you saw in my presentation, this was a collection of thoughts, and I don't quite. And these thoughts are about difficulties of how we actually understand about inflation targeting. What we understand constitutes inflation targeting. 30 years ago, it was quite easy, much easier to recognize an inflation targeter because all were trying hard to build something that they did not have. Whereas today, we see a lot of countries adhering to inflation targeting simply to use a trademark, that logo. So how do we actually distinguish between the two? As I was trying to show in my presentation, it's quite difficult in practice, and so as a food for thought, I'm trying to come up with a negative, something practical, and what practical here for me is a negative definition. In other words, let's try to say when we do something as inflation targeters, and we're trying to see, is this still consistent with an inflation targeter? Let's try to ask a negative question. When will it not be consistent with inflation targeting? What would need to happen without taking into account fiscal considerations or balance sheet policies or fixing the exchange rate? When will it already stop being compatible with inflation targeting? And I think that could be a more practical question than the other way around. And the motivation for this thought here is actually a quote from Samuel Huntington: "Unless we hate what we are not, we cannot love what we are." And I hope it provides a useful conclusion for my speech. Thank you very much for your attention. I do see I have some questions, but I'm not sure. I'll leave it to the moderator to see how we are.
Okay, David, thank you very much for very insightful lecture. So I share many points you presented, and I suppose I would love to ask you a few questions. Probably have to start with the question from the audience. I see the question on Tom Rui, who is National Bank of Ukraine.
Yes, it is. All right. I think it's one of the more difficult questions, and I would try to answer it in the opposite way, as I suggested at the end of my speech. So when will it not be consistent? It will not be consistent if the interest rate corridor is very wide, and if the interest rate fluctuates too much. In other words, if it's stuck towards the lower end of the corridor, and it's there, and if we move the corridor with the key policy rate, it moves with it, then I think it's still okay as inflation targeting. It's not ideal, and there is work to do, but definitely was something that I would work on as a central bank. But it would not be yes or no for inflation targeting characteristic of that central bank. But of course, if actually the lower bound is 0 and interest rates happen to be 0, stuck at 0, which actually happens for some central banks, and the key policy rate is at 6, whereas and we see then interest rate in the market to be stuck closer to 0, which, or something close to 0, which happens to be the corridor in the Freiburg case, then it would not clearly be compatible with inflation targeting, because you want your interest rates to be commensurate with your view of what macroeconomic policy, macroeconomic developments, the business cycle, and risks that the economic agents face when investing into the economy. So that's, I hope I answered the question. Glad the question.
Thank you, David. One more question from participants. From your point of
good now, process. I see. Well, this question goes into the preconditions to be done for successful inflation. An excuse for if someone wants to say establish inflation targeting and sees a lot of structural problems and privatization issues and a lot of administrative prices regulated, can they still target inflation? I think yes, they can. It will be more difficult, but they still can. And in many cases, it's the right thing to do in such cases because someone needs to start with the reforms, and then, in my experience, the reform process tends to be self-reinforcing. So once you start, say, moving this inflation targeting in a not very conducive structural environment, structural policies gradually will come along, and so we'll find a much better climate than if you had not started with inflation targeting.
Thank you. What you do on that IT regime both the real growth. Probably that question relates your to base the get the credibility you need to suffer in order to get it here. And yeah, so please, what is your answer on that?
Again, so I see. Okay, I have see the question. Okay, so again, I saw evidence one way or another. I do not think that simple inflation targeting. I don't see a mechanism through which inflation targeting would slow GDP growth. The evidence, I'm sure I can show evidence to the opposite, and I'm sure that you can show me the evidence supporting this claim, empirical evidence. But I just think that there is simply monetary neutral. But that what would that contest of evidences show in one sentence would be that there is simply monetary neutrality, and the choice of monetary regime as such has no long-term consequences or not medium-term consequences for GDP growth. And in terms of welfare, I do think that inflation targeting is actually better in terms of welfare, considering especially if we have welfare functions that take into account socially challenged parts of population. I think that inflation targeting does help welfare of these groups tremendously.
Okay, thank you very much. Mostly
we have this debate about using exchange rate as an instrument alongside interest rates for inflation. So I think things theoretic, but it happens. There's something that works in theory, may be very difficult to implement in practice. So again, today, it's hard to find an exchange rate, an inflation target among emerging market economies, which would not be engaged in some form of forex market activity. Can this forex market activity be done in a way that is compatible and reinforcing inflation targeting? Yes, it can. Is it easy? No. And again, ask yourselves. When answering your question, I will ask myself when would it not be compatible? It would not be compatible if I'm trying to change the course of the exchange rate. That would, for instance, I would use exchange rate for targeting exports or supporting GDP growth, whereas I would use interest rates to support inflation targets. So that would really be not compatible with inflation target, as an example. So it would very much depend. I would, of course, try to discourage everyone to use forex interventions automatically when trying to build credibility for inflation targeting. Because there's a big difference in the operations of a central bank and money market. And the difference, and therefore the two instruments, interest rate and change the money market, is the voice. So if where it's the central bank dependent with the world, and its capacity to implement any kind of intervention policy is quite limited often, and the credibility lost through such operations may be serious. So yeah, it can. So in other words, again, it can be done. Many do that, but it requires some thinking and some practice. Do it right.
Okay, thank you. We have one question from the of the Central Bank of South Africa. The importance of credibility, you demonstrated your argument. You, however, didn't say anything about fiscal credibility. Shouldn't that matter for response of yields? Actually, may I add something to the question?
Comparison, okay, it can be done. Too difficult to do. Just a quick answer to the SARP question and to the particular example I used. I am aware of that, and I agree that would have been important. But I selected these three countries because both Egyptians that situation and Ukrainian that situation, fiscal debt is quite precarious in general. So I considered both of them comparable in that respect, although I didn't do any formal analysis of that. The Czech Republic is very much different, although its so that's not probably comparable, but there's a serious worsening of the fiscal situation over the last few years, not only related to COVID, but also pre-COVID. And we are likely to hit our debt ceiling break in about a year or two. And so while it's not comparable to the situation of Egypt or Ukraine yet, we may start having serious fiscal consequences feeling them relatively soon as well. Czech Republic was not comparable.
Thank you, David. May I ask you about the trend in expanding central bank's mandates with ECG goals? Do you think it's the right time for such changes in emerging now?
Well, again, it depends where. It is one of these questions I'll ask myself: when will it not be anymore inflation targeting? So, consistently implement them, and whether that's a job of central bank. I think it's not a job for the central bank. I think these goals are important, but I would not probably put them on a burden. Should not be a burden of the central bank actually to do that. And I think we tend, central banks in our countries, in emerging market economies, are often the most credible institutions, the institutions toward that may have fallen victim to their own success. So everyone is looking out to them for guidance and credibility, and or actually everyone wants to put a lot of burdens on them. Oh, please do that and look after this and look at that. So I think it's society-wide policy, and not necessarily something. Central bank mandates should not be able to look at.
Okay, thank you very much. Fair enough. And probably we have the time for the last question. What is your view on nominal GDP targeting instead of inflation targeting?
All right, it's a good question. I think it sounds nice. Again, it's one of the theoretical concepts that looks nice, but it actually practical implementation is very, very difficult. First, you do not know what its natural rate of growth, GDP growth, or potential rate of GDP growth is. Without that, it's any kind of practical target is very difficult to implement. That's one thing. And second, you're trying, inflation targeting itself is about trying to manipulate expectations, make them anchored to the target. The problem is that when you start doing nominal GDP targeting, you're actually leaving the question to the participant, to the actors. You're not telling them where the expectation should be. You're trying to ask them, please figure out for yourselves what the inflation expectations should be. So it actually goes as, in fact, implementation the nominal GDP is very to work for it, I think. So it's not important, but implicit. Just I hope I answered the question.
Well, thank you very much for your very insightful presentation. We really appreciated a lot of the messages you provided to us, and very nice figures. And thank you very much for your bright answers to these questions. And fortunately, for your definitely will be happy to continue our brain. Marco managed to coordinate the technical assistance from that I am I used to work as a consultant. First of our today's workshop.
Me and see me. Sergei, thank you so much for your kind words. It is actually fantastic to see you and all the friends. I greet all my friends at the National Bank of Ukraine and in Ukraine in general. It's a great pleasure to be again, if not physically, then at least virtually in contact. I would like, of course, to thank, first of all, Governor Shevchenko for his thoughtful, brief but thoughtful introduction, as well as a good friend, David Vavra, with whom I shared working notes. And you could see on the map he showed that Ghana is an inflation targeting regime. That's to a large degree thanks to his effort. But not to lose too much of our time, what I see my role as a moderator, first of all, we have the title of the conference, Inflation Targeting in Emerging Economies. So let's focus on them. The first panel is entitled Monetary Policy Toolkit During Pandemics. So basically what we should try to focus is on what instruments, tools were used during pandemic, but especially in emerging markets. Before I introduce the panel, let me briefly say a couple of rules which I shared with my my fellow panelists. I'm a moderator. They speak. They are professional. What we agreed upon is that each of them will speak about 15 minutes. We will take questions afterwards. I think this is much better because otherwise we risk that the last person is crowded out due to time, and we don't want to do that. We want to give equal opportunity to each of our panelists. So please refrain, keep your powder kegs dry until we finish, and I will try to be brief in the introductory remarks. So without further ado, I'm not going to try to be a smart moderator and give overall views. Maybe at the end, I may ask some questions, but what we have agreed, again, as you can see, we did a lot of preparations, is that the order of presentation will be first Joanna will speak, then we will have Dimitar, then Chaba, and last but not least, let me very briefly, all the participants have very impressive and long CVs, so I'm just going to touch upon most important issues. Joanna has been with the Central Bank of Poland, National Bank of Poland, for more than 15 years, sorry, 15. She spent a couple of times, well, you can see her that she is quite young, so I would say probably 5 years is more just spend a couple of years with your 50 minutes are starting right now. The floor is yours.
Can you hear me now? Okay, thanks. I prepared the presentation, so I would like now to share it with you. I'm not sure if I'm allowed to. I think for now I'm not, because it's not working, and there are some slides that I would like to show you. I will press again the magic button. Okay. Okay, maybe this is it. Let's try. Can you see the presentation now?
Yes.
Yes? Okay, that's great. Thank you, Marco, for your kind introduction. And I would also like to thank David Vavra for noticing my research of 2018. But what I will focus today is my more recent paper, so don't worry. The paper is entitled Initial Monetary Policy Response to the COVID-19 Pandemic in Inflation Targeting Economies. So I hope it will be a good starting point for the session, because it's also focusing on broadening the policy toolkit used during the pandemic by inflation targeting economies. So I hope you will find it interesting. Of course, the usual disclaimer applies. So the presentation presents only my views and is not meant to present the position of the National Bank of Poland. So as we all know, monetary policy response to COVID was exceptional in many respects. And what I investigated were several aspects of this exceptionality among inflation targeters. And in particular, I looked at the scope of the adopted measures, the sequence of announcing new instruments, the timing of announcing the policy response, and factors influencing what I called inside decision lag. And that inside decision lag is just the time between registering the first COVID cases in the country and the first monetary policy loosening justified explicitly by the need to mitigate negative economic consequences of the pandemic on the economy. In the paper, I analyzed publicly available information and data taken mainly from central banks' websites, the IMF and the World Bank databases, some indicators of capital account openness proposed by Fernandez et al. And Chinanito, an index of stringency restrictions aimed at mitigating pandemic proposed in Hale and other, and some indicators of institutional setups governing the central banks proposed in my past and forthcoming publications. I took on board 28 inflation targeting economies. Half of them were advanced economies, the other half, 14 countries, were emerging market economies. The period that I investigated began around the outbreak of the pandemic, which was early 2020 and ended in June 2020. So it covered the first half of last year, but what is important is that the bulk of monetary policy loosening introduced in response to pandemic indeed took place in that period. And I introduced two main division lines, along which I tried to find some similarities of differences within the analyzed group of countries. First, the distinction between advanced economies and emerging market economies. And second, also the distinction between countries hit by the pandemic in subsequent months. I'm like, for simplicity, I'm calling them January, February, March wave of the pandemic. Of course, we now use the word wave of the pandemic to describe some different phenomenon, but in my presentation, the wave, for example, the January wave would mean economies hit by the pandemic in January 2020. So here I'm showing you the overview of the countries that I analyzed, divided in those two subgroups, so the January, February, and March group, also indicating with those letters A and E whether the economy is an advanced economy or emerging market economy. What is important is that the January wave comprises predominantly from advanced economies, whereas the March groups, or with the exception of one country, all the others are emerging market economies. So the composition of the group is quite different, and that will also have a reflection in some findings that I will discuss in a minute. What you can see from here is that the economies that are included are different. I mean, there are small, medium-sized, the biggest countries in the world, but what they have in common is, of course, that they all follow inflation targeting framework, so it makes it a bit more fair to compare the monetary policy reaction to the shock called the pandemic. In the paper, I showed evidence that the number of decision-making meetings had during the first few months of 2020, including extraordinary meetings, was outstanding, that the intensity of announcing new measures or extending the already introduced instruments was unprecedented, that the acceptance for a much broader policy toolkit in countries previously following rather conventional monetary policy was very wide, and that the initial policy action within emerging market economies was much faster compared to advanced economies. And I will also try to show some factors that can drive that difference. So starting with the evidence that the number of decision makings, I'm going to graph the average number of meetings followed by indeed response to COVID, and followed by any monetary policy explicitly to the pandemic or epidemic at that point, because some countries were already in January announcing somewhat yet. Anyway, what you can see, like the average number of meetings independently, whether we compare advanced economies to emerging market economies or those in those subsequent pandemic waves, was almost the same. But what is visible at the same time, that the extraordinary meetings were much more frequent in advanced economies compared to emerging economies. But the reason for that can be that the pandemic number of decision-making meetings in advanced economies was as for emerging economies, it was typical to me. So on the previous charts, I was only counting decision-making meetings, but of course, moments were implemented by simply announcing them at the website with the press release. For example, relaxing the requirements for entering certain operation, or extending asset classes to be purchased, or in the scale of asset purchase. So no decision-making meetings were followed by actions, but also actions were implemented by press releases. So here I'm counting all of them, and you can see, with the exception of the US, that the market economies and advanced economies in the number of announcements in the first half of 2020 in response to COVID. But what is another point worth mentioning, that for all countries, the typical number was between 5 and 10, which is kind of impressive. So this I would show an overview of monetary policy measures used during the pandemic, talking only about three measures. So the conventional cuts in interest rates, and the two measures called, at least until now, rather unconventional, so asset purchases and credit schemes. In my paper, I'm also reviewing other monetary policy actions, so liquidity providing measures, including also, I'm looking at the FX intervention, so the scope of the paper is broad, that constantly that the reach during the option, and also reach for asset purchases. I think it's very popular. I mean, almost all, maybe not almost, but as you can see from that table, very many central banks, also from emerging market economies, decided to use those instruments. And for comparison, I'm showing you the same table, I mean, for the same countries, for the same measures, but taken during the global financial crisis. So the first episode when those unconventional measures became kind of popular, but this was much more true for advanced economies at that point. So also the number guesses in our tables is compared to advanced. This is the comparison. I mean, now during the pandemic, the reach for those measures was much more broad than during the global financial crisis, and I think that's the most telling table. Here I'm just showing you some information on cumulated interest rates cuts, countries that could lower the higher policy rates when the pandemic hit, and that's also translated in the bigger room for maneuver with that respect. And they did use the option to reintroduce a lot of monetary policy using with that measures. So for interest rates cuts, of course, emerging market economies were more aggressive in lowering them. But when we look at the asset purchases and credit easing schemes, although in both group of countries, the reach for those measures was high. Here, if we look at the data on how much assets were purchased and how many credit easing schemes, I mean, what was the scope of those credit easing measures in certain countries, you can see, although for some countries the data are missing, or at least I couldn't find them, the intensity of using those instruments was much higher in advanced economies during the pandemic. And here I'm also showing that inside inside policy response lag, so the timing needed for central banks to decide that monetary policy response is needed. I looked first of all when the pandemic hit economy, and then around that point, I looked at all monetary policy.
Monetary policy in emerging economies during pandemic. Yes, the title is this time was different. It's not very original, I know, but it looked to me quite convenient for this occasion because it was really different. And I will try to explain why. To explain this, first I will answer two questions. What were the underlying conditions in emerging economies before pandemic relative to other crises that they faced in the past? And then why it was possible to use monetary policy tools that are not typical for emerging economies. Then we'll touch upon the policy tools actually used during the pandemic. And I will end up with the question, could this policy toolkit stay for use in future crises? So let's start with the underlying conditions. We know that in previous crisis episodes, usually emerging economies were experiencing capital outflows and currency depreciation pressure. This was like a typical scenario that was happening there. That would tie the hands of monetary policy, putting the central banks in a situation to conduct pro-cyclical policy and try to establish the balances by reducing demand. Therefore, the response usually would be raising policy rate and FX interventions. Sometimes even capital controls were used in more severe cases. And this was quite different from the policies pursued by advanced economies in similar situations. The COVID shock presented a problem that had never been faced before. A global sudden stop of economic activity caused by pandemic. Nevertheless, initial developments were playing at the usual script. At the beginning, in March 2020, capital flows to emerging economies dropped in a larger sudden stop that, according to, for example, Institute of International Finance data, was almost 4 times bigger than had occurred during the taper tantrum in 2013. And it was even bigger than in the global financial crisis. That was followed by currency depreciation. Ukrainian hryvnia, for example, depreciated by around 12% in just 20 days in March 2020. And these developments actually caused emerging economies to be more cautious in their early policy responses. However, after initial market panic, capital flows quickly stabilized after March. Most emerging economies limited their drawdown of reserves to about 5%, compared, for example, to 15% during the global financial crisis. In Ukraine, for example, the loss of reserves was 8% and limited to only a month. For comparison, during global financial crisis, the loss of reserves in September and October 2008 was 16%, and the bleeding of reserves continued till April 2009. The total decline at that time was 35%, so very big difference with what happened during the pandemic. And several factors played the role in quick stabilization of the situation after March 2020. So first, here we have to mention the fast and aggressive reaction by the main advanced economies, central banks. It stabilized financial markets and contained risk aversion. It gave emerging economies more policy flexibility. Then the existence of FX swaps agreement of Fed and ECB with many emerging economies. This helped central banks in emerging economies to limit tensions in FX markets. And we have to mention very prompt response of the IMF, which disbursed $100 billion to rapid financing facilities. First disbursements were already available in April, so extremely prompt reaction by IMF in this episode. Then the better macroeconomic fundamentals in many emerging economies than in the past. Smaller current account deficits, which reduced reliance on capital flows. Then larger reserves, more flexible exchange rates. Strengthened credibility of inflation targeting regimes. For example, inflation rates was much lower than in the eve of the global financial crisis. Ukraine was a typical case of this. So we saw actually in reality benefits from NBU reforms in the previous years. And the last factor, there was general understanding that this shock was not caused by domestic imbalances or policy mistakes in emerging economies. So financial market participants were less likely to be alarmed. All this enabled emerging economies to ease monetary policy in response to a global shock. Actually, to pursue counter-cyclical monetary policy, which was quite unusual, as I mentioned before in previous crisis episodes. Usually it was not the case. Moreover, even emerging economies, which had previously relied mostly on adjustments to policy rates and FX intervention, began to use asset purchases and other new tools without generating a negative market reaction. There were, however, substantial differences across countries and in the extent that they use these new tools and their corresponding ability to pursue aggressive easing policies. For example, in countries which had shown less support for the independence of their central banks and the inflation targeting regime, there was limited ability actually to reduce interest rates without triggering capital outflows. I would mention Turkey here as a typical example. Emerging economies central banks have operationalized a set of tools to stabilize financial markets and help keep them functioning. 92% of central banks have cut policy rates since March 2020 to all-time lows in many cases. The Governor Shevchenko mentioned in his introductory remarks that Ukraine also reduced the rate to historical low. 58% of the central banks used FX intervention, 52% reduced reserve requirement ratio, 44% of central banks introduced term repo. Ukraine was also a case. 34% initiated government bond purchase program, 8% private bond purchase program. As it can be seen, in addition to rate cuts, many emerging economy central banks have taken measures to provide liquidity to the banking system and launched asset purchase programs for the first time, making this a truly unique policy response. Still, emerging economies are more reliant on bank credit than on market financing, and therefore they are focused more on providing liquidity support to banks rather than outright asset purchases. Emerging economies were particularly cautious in adopting asset purchase programs and more modest than advanced economies. They often restricted their purchases to a smaller scale and limited set of assets. A part of Croatia and Poland, whose purchases were around 5% of GDP and quite close to purchases of euro area. The other countries' programs were much smaller. Some countries, such as Brazil and Chile, gave the central banks new legal authority to purchase public debt, but they never actually started these purchases. Central banks with policy rates well above zero, like India, South Africa, Philippines, they tended to operationalize asset purchases as a tool to improve bond market functioning. And central banks with policy rates closer to the zero, like Chile, Poland, Hungary, they use the purchases actually to ease the local financial conditions, to provide monetary stimulus and to improve market functioning. Purchase of government assets was limited in most of the cases to the secondary market, except in a few cases, and they explicitly were mentioning this. For example, Ghana, Guatemala, Indonesia, Philippines, they explicitly mentioned that one of their objectives was to temporarily ease government financing pressure during the pandemic. In general, the experience of emerging economies with non-standard policies during pandemic has been positive. We will see later the general views here, but so far what I have seen written, yes, it was seen as positive. Nevertheless, one should be cautious in using the same policies beyond the current pandemic related to extraordinary situation. There are several risks that have to be borne in mind when we talk about possible future use of these non-conventional monetary policies in emerging economies. First, we should mention institutional and central bank credibility can be weakened. This is a real risk. During pandemic, markets appear to have been reassured by the limited and time-bound implementation of these measures under the extraordinary conditions. So the next crisis might be completely different. Then we have to have in mind the risk of fiscal dominance. When central banks of economies with weak fiscal and monetary policy frameworks become buyers of last resort with large-scale and open-ended asset purchase programs. Asset purchase programs can escalate also capital outflow pressures, particularly in countries with weak fundamentals. These purchases could press the yields down, and this then could be an obstacle for investors because it will reduce the risk premium on these markets. And the last but not least, I will mention a long-lasting presence of central banks as buyers in the local currency bond market is likely to distort market dynamics that could impair the price discovery process and also financial market development. So I will conclude here my brief presentation by saying that this time was possible because conditions were different, but we should be quite cautious using the similar policy tools in future crises.
Okay, thank you, Dimitar, very much. I appreciate you being within your time limits. You even earned us 2-3 minutes of time for discussion. So I understand the title this time was different. It's not like the ironic title of Reinhard Rogoff's book on debt from, I don't know, 15 years ago, probably, but really it was different. Let me just point out that I appreciate you mentioning fundamentals a couple of times, but we will come back to this, of course, in the discussion. So let's rush to our next speaker. This is Csaba Balog from Hungary, Hungarian National Bank. He has, like other, very extensive career from Hungarian Competition Authority, moving to National Bank, different position at the National Bank, even working on new instruments. So I guess this should come in handy when we talk about this. And I read from 21, so it's quite recent. He's head of monetary policy and financial market analysis directorate, and we congratulate you on your new position. And basically, Hungarian National Bank has reorganized several instruments lately. On top of it, he teaches at Corvinus University and other training courses. I understand you will be focused more on the Hungarian case, if I'm not mistaken. But anyway, that's why you are after Dimitar. It's not otherwise. So let me give floor to you. Your 15 minutes start now.
Thank you very much. Could you hear me? Is it okay? Okay, thanks. And thank you very much, Marco, for the introduction, and of course for the Ukrainian National Bank for inviting me. And a special thanks for Marco to pronounce correctly my name. I think this is the first case in an international meeting that my name is Csaba. Is not an easy name in international context. So thank you very much. That was really kind. I try to share my presentation. I hope that probably you can see now. Is it okay? Yeah, thanks. And I put it full screen. Okay, thanks. Yes, yes, I'm quite new in the total monetary policy task in the Central Bank of Hungary, but I also work for the same directorate for almost 20 years. So I have the experience, I guess, to take a pic, to show a picture for you. But I, of course, I try to have the international context as well. So I really enjoyed David and Ioan and Dimitar presentations or speeches about the international context. I have more slides on the Hungarian topics as well, but I put in context to the international environment. So I try to concentrate on the flexibility of the IT. I think that's really a valuable the feature of that, and it was really useful in the last couple of months, quarters during the COVID crisis. But I would, at the beginning, I would turn a bit back before the crisis, because I think that was really crucial and important for us as well, but I think for the majority of the advanced and emerging countries, that what happened before the crisis. As I think David has a similar picture from the National Bank of Poland, we have the same picture that IT is really widespread in the world, and I think in Europe as well. So the neighboring countries as well has the same. And what is, I think, more interesting, that IT is not the same for all IT targeters. So there are some countries who are using point targets. You can see, I think, less than 10 of those countries. There are who has only target range, so there are no midpoint, like Israel or Thailand, and there are some others who has a midpoint as well, but there is a tolerance band or target band, how they call it. We have a point target as well, and the tolerance band with a 3 percentage points. So we have this, I think, the most the countries with the, I think, the 6 or 7 countries with the same target framework. And we have that kind of framework from 6 years. So we changed the tolerance band in 2015, and we have this 3% quite long time we have. And we have from 2001 the inflation targeting, but we had a mixed system before 2008. And the beginning of 2008, we changed the exchange rate regime to a total flexible one. So that's why from that time we had the academically correct IT framework. I think it was not the perfect timing in 2008 to have a flexible exchange rate target, but exchange rate regime. But that was of course not. It was accidentally did that time. I would turn what happened in the recent months in international comparison. It's interesting that I think the flexibility is increased. If you look at the Fed or the ECB, they changed the IT regime, if you can say that they are using IT. So it's more or less IT, I can say in both occasions. So the Fed is using an average inflation targeting, and the ECB changed to a symmetric 2%. And as I mentioned, we had this inflation tolerance band, which was also useful in the last couple of quarters. And what is interesting, of course, for the Fed, that they had the full employment, other second objective target, or it's a similar importance for them. And that's why I think it's really interesting for them what to do in the next months. And ECB and also the Hungarian Central Bank has the green aspect incorporated already in the monetary policy framework. So we have also concentrating on the green aspects, and we had a green loan program as for example, and of course we are trying to regulate the banks and financial institutions, and to regulate markets as well to promote the green changes. Turning to the interest rate policies, what happened before the crisis, it was, I think, really interesting that globally there was low interest rate environment. I put here some countries, of course, from the region, but and the major central banks, but I think that was quite a common phenomenon. Of course, the levels are not the same. I think for the emerging markets, the low interest rate environment, of course, it's a bit higher than for the advanced markets. But the common point was, I think, that we had quite a low. Of course, there were some countries like Poland and the Czechs, and of course Romania, that started a bit tightening the interest rate environments, and of course the Fed was I think the fastest in the advanced economies who did that. But finally this 2 percentage point of interest rate was quite low, and I think that was a really crucial point what to do in the pandemic. And just to turn to the Hungarian experience is why we had this. You could see here that we had quite a long low environment before the crisis as well, because we had a really low inflation environment after the crisis. We after 2012 we could have a really low, but it was sometime below zero. That's why. So we had a problem with the lower inflation rates, and that's why we use a quite loose monetary policy environment. Not only the interest rate environment, but the other tools as well was used this quite long time in Hungary, and that was also useful during the pandemic crisis. So we had a lot of experiences about the non-conventional monetary policy tools in an emerging market. And if we are turning to the crisis, I think it was really clear for everyone that the central banks should react rapidly. And as Joanna already showed us, that probably the emerging market was faster, but I think it was quite one or 2 months differences between the central banks. So I think globally they were quite fast. And I just put here the major central banks, that how they started to increase their balance sheets after the Fed or the Bank of England started to taper already or decrease a bit their balance sheet previously. It really quickly increased again from 2020. And it was quite similar for the emerging market. I just put here some regional countries and the ECB as well. So you can see how the balance sheet increased from February 2020 till the end of that year. Of course, that's changed a bit more in the last couple of quarters, but the picture is the same, that every central banks increased. There was, of course, difference between the intensity, but the picture was the same. And again, some Hungarian experience, that what we did and what was new, the new tools was a bit less than I think is it in this list, because we already used some of those before the crisis as well. We did two major directions. We did increase the liquidity supply in the market and in the banking system, and we used non-conventional instruments to affecting long-term yields or affecting the credit markets and other markets as well. So that we use the liquidity supply, like we expanding the eligible collaterals. We use FX swaps providing liquidity, and we loosened a bit reserve requirement as well. So that was, I think, more or less conventional. We use the FX swap in Hungary, I think, from 2008 continuously. So it's not a new tools for us, but for an emerging market, I think that can be useful. And we are using it both directions as well if it's needed. And the last couple of quarters we use the other direction, FX swap as well. And what about the non-conventional? We use the funding for growth scheme, is quite close to the Bank of England scheme. We used it from 2014 continuously with several waves. And of course, in the pandemic crisis, we have a new program for that as well. We had a new program from the previous year, and we easing that conditions for the bond funding for growth scheme. It's really important for us because we have not really a real bond market in Hungary, and I think that can be a case in several emerging markets. So we try to build a new bond market to prepare for later crises, and it was really helpful that we started in 2019, and we can continue that program. We also use the long-term repo facility. I put here to both sides because it's of course increased the liquidity, but of course it was majority of that was 5-year long. So we put the long-term yields lower with that. We used the government securities purchase program, and we had a mortgage bond purchase program as well. So it was quite a long list, but we used both of them, and I think that was really useful to have a really quick recovery in the economy. And turning to the most recent time, so there was a quick recovery. I think that was really common. Of course, the pace, the recovery speed was not the same, but the direction was the same. But the inflation is also came back with the recovery, and now I think all of us have the same picture that inflation is much higher than inflation targets. We have a higher inflation targets than the others in the region or in the advanced economies, but of course the inflation is higher than the 3% as well. So we already entered in a new phase, and the new tightening phase. And I think all the regional and the majority of the emerging markets, and there are some advanced markets, central bank as well, who started tightening in one or another way their monetary conditions. I think in the region, the Czechs and the Hungarian central bank was quite closely started, and we have this week again we had some interest rate increases, so we are quite close to a bit more than the 2.75 of the Czechs, but all the other countries started the same tightening cycle. I think the future is unclear for us, so it will be really interesting what will happen, and how the interest rate and other methods of tightening will continue. We also started to phase out our non-conventional measures. We already in June closed our FGS Go, and we in July ended the long-term repo facility. In August, we started to gradually withdraw the government securities purchases. September, we phased out our FX swap facility. And now we are on the other side, we are trying to absorb liquidity with a new instrument. At the end of year, we will use that one to have a bit lower liquidity in the system, and to better control, to have a more efficient control on short-term interest rates. So that was my presentation. I hope that I'm in time. Thank you.
Thank you so much. Very interesting in-depth analysis of what's happening with Hungary. Well, we are neighbors, so it shouldn't be too difficult for me to pronounce your name correctly.
Yes.
And now, last but not least, it's Elena. The reason why she's last, because the title of her presentation is Post-Pandemic Monetary Policy. So next time, if you want to be the first one, you should say Pre-Pandemic Monetary Policy, and I will put you in front. Nevertheless, Elena has a very impressive CV, like the others. She worked at Bruegel. As you know, this is one of the most respected European think tanks. Deutsche Bank, she taught at Stockholm School of Economics, London School of Economics, Chicago booth in London, and so on. And now she's with the IIF in Washington. Let me share a small secret with you. I almost joined the IIF in 2005. A long time ago, chief economist was Yusuke Horiguchi. I don't know if you ever heard of him. He came from the fund, but my family obligations turned me otherwise. I still have a very, very high respect for IIF. So please, the floor is yours. I understand you will not have a presentation, so we are listening very carefully to your speech. Please.
Thank you very much. That's very kind. All I can say that Washington, D.C. is a nice place to live, especially with the family. But I will go over the following few issues. So I'll talk a little bit about the recovery in the developed markets, what is happening with the rates and policy expectations there, and what that means for emerging markets. So that's how I'm going to structure the presentation. If we just start very quickly with the recovery in the US, it's almost by any measure on the output gap trends, some of the labor market indications, and of course the esteemed central bankers here know very well how hard it is to assess properly the labor market indications. But one would think that the US is coming back to the pre-trend growth. And given that the US is coming back to the pre-pandemic trend growth, of course, we see the pressure coming up on the US yields. And very different from what we have seen earlier in the year, the pressure on US yields to what is priced in, and you can look at 5-year forwards or 5-year, you don't have to go far out, like 5-year forwards out. You can just look at the closer front end, and you see the pressure there for the hikes. And, to the extent that we sort of traditionally look at this rate, you know, the pressure is more to the front end. It's most likely that the market is asking for the central bank hikes. The Fed has managed communication around the taper tantrum very successfully in autumn, and it probably should start turning its attention to communication about the rate hikes as well. I think the reason has been sort of relatively confused of late is because they themselves didn't expect such a swift return to the pre-pandemic growth trend. As you know very well, we never made it to the the global financial crisis trend growth in the US for a number of reasons, maybe also because of the inflated trend growth before, but also maybe because of the permanent damage to the economy. So having learned that lesson well, they've, as my colleagues here described, they've unleashed their policy support very quickly, and then basically within almost just a year, they came back to the pre-trend growth. That is also together with very strong increase in commodity prices, which is partially supply driven, but also partially demand driven, and the bottlenecks in the supply chains, which we don't need to repeat because we're all familiar with that. So given all those factors, inflation, as I was talking to some of my colleagues in emerging markets, we're placing small bets on when it's exactly will cross the inflation in emerging markets, that then the 12 months out, US is likely to have much more than the emerging markets. So inflation is going up, and also consumer expectations and business expectations of inflation are going up sharply. So basically what we do expect that if communicated properly, given what is already priced into the curve, and of course that changes, but sometime next year they should be hiking, and hopefully they will manage their communication as well as they have managed their communication around tapering. So we talk a bit here about QE in emerging markets versus developed markets. And of course, all of us know that given that US has the privilege of having their sort of risk-free curve being the risk-free asset for everybody, Federal Reserve, the Fed has financed a big chunk, or almost more than half of the extra fiscal stimulus that came through. And of course, it will expect it to continue to do so. So they have this extraordinary privilege of being able to print money and do that for direct fiscal financing. Of course, something that we cannot possibly do in emerging markets quite yet. So why am I spending time on this? Of course, apart from the obvious rates and the tapering spillovers that we have seen in the past potentially give shocks and make our monetary policy much more difficult, I also wanted to flag the direct spillover shocks from inflation to inflation. And you're probably familiar with Christian Forbes' paper some years ago when before the COVID, when a lot of developed markets were confused. So how do I estimate my R star? And if you remember our old books, you know, in theory, actually R star should be more or less the same across the world, right? You know, if you go to very basics. But, you know, a lot of developed markets were thinking, so how do I estimate my neutral rate? How do I think about it? And then also thinking that, wait a second, there seemed to be spillover from one country to another. And Christian Forbes did very simple analysis, was the PCA analysis, and she showed that, look, you know, we have much more co-movement in developed markets inflations than we have ever seen historically. And that's what happened in the last 5 to 7 years. It could be global supply chains changes, it could be better integration via trade or other channels, labor, but this is something that we're observing. And this is not just because of the commodity price swings. So you can try to put that common PCA, look at it, sort of extract your common PCA and compare it to what's happening to commodity prices. Not just that, there is some other sort of global factor. So what we've done something similar for emerging markets as well, and we've noticed that as well before the pre-COVID shock. So you have much less variability, and some of my colleagues showed here on the slides the EM inflation, much less variability in EM inflation. And if you try to extract this common factor, again, it accounts for larger share of variability in emerging markets, not just the domestic factors. And also it's not only the commodity prices. So if you try to use that for commodity, it's not only that. So what we need to worry about is not just the spillover contagion via rates of the US tightening, or I'm not talking as much about ECB because I think they have still some time, and of course for our markets ECB is important, but for the global capital flows, the US can be almost more important. But we also should worry about the spillover from the developed markets inflation directly to our inflations in emerging markets. And that's something that I think in a lot of sort of literature, we're not thinking about it as much. So that's something that I wanted to flag for the monetary policy outlook. Very quickly on the ECB, and again, I know you know more about ECB than I do. Of course, we're looking at the December meeting. For the ECB, for the euro area, we feel that there is more space for them to wait. Of course, there is an average. There is always this joke about the average temperature in the room, having said that, there is more space for them to rate. We are looking for more results on the survey, on the analysis of the policy framework, on the update on what they're doing with the asset purchases. But somehow we feel that in the coming months it will be less of an important story globally for global inflation and also for global rate changes than the US. It is sort of more the Fed and the US that need to decide what they can do, and also potentially and potentially the risks of the spillovers, not only via rates, but also directly via inflation to emerging markets. As my colleagues pointed out, emerging markets started hiking much sooner. And there is a small concern there that I have is about the domestic policy conditions, about the domestic growth conditions. And again, there is always, of course, a trade-off with inflation and growth, and emerging markets generally in their mandates, or most countries' central banks and their mandates have inflation as their priority. But there is a risk where there is a policy tightening occurring in emerging markets on both fronts, on the fiscal and monetary policy side, while the developed markets still have time to sort of go full steam ahead, potentially look through their much higher inflation and support their economic recovery. Well, the reality of emerging markets that they're in sort of more orthodox response, which is definitely something that I'm not disputing with the validity of that response, but the outcome might be that emerging markets might be coming out of the pandemic on a less even footing versus the developed markets. So they might have less fiscal space and less monetary policy space to allow their economies to heal and also to start looking in the new directions. And we discussed here briefly ESG and digital. So that's something that might be a differentiating factor going forward and something to watch out for, especially as we do get concerned about the new COVID variants that even today we're discussing yet another new COVID variant and the validity and the effectiveness of the vaccination and the booster shots. So now moving on to the sort of the link between developed markets monetary policy and inflation and emerging market monetary policy and sort of the via capital flows. So in terms of our capital flows forecast, we see that we have a sort of a health recovery. We had very strong beginning of this year, but what curbed that recovery was mostly new COVID variants. It doesn't seem to have been either dollar appreciation or rates from the US or even the taper talk. I think the bigger factor it seemed to have been the new COVID variants that hit Asia hard and then of course spread through a few other countries and more globally. So we do need to worry about this still the pandemic. We're talking about the monetary policy, the post-pandemic world, but it looks like it is a pandemic world for much longer. So in terms of the capital flows, this new variants almost had a bigger factor this year than any other monetary conditions factors for the global economy. In terms of the capital flow outlook for next year, we do see sort of similar flows to what we have seen this year. We also see that flows in terms of hard currency or credit are much stronger than flows to local markets. And of course, it's not surprising given the inflation that we're discussing now. But what I find interesting in terms of the sensitivity of emerging markets credit spreads to global factors is that it has become more muted than what we have seen in the taper tantrum. So if you sort of look at the regressions of spreads of emerging markets on global factors, it is less clear whether the dollar factor or global volatility factors, we all oftentimes use VIX or other types of volatility factors, they are less strong they have much less of an impact than they had during the taper tantrum. And that's something interesting. It seems that the emerging market credit issuance sort of earned their more sort of commonplace among asset allocators. It's less of an exotic instrument, and it seems to be less exposed to the swings in the global factors. From that side, we might need to worry less from the contagion front. In terms of the local markets, however, there are, and we talked again about the cuts into the COVID, the fact that the credibility of emerging market central banks allowed us to cut and also do other sort of unorthodox measures. I think here, in terms of the local markets, the situation is a bit more uneven from the global side, and it's not always a bad thing. So the recovery of flows to local markets has been a bit more subdued, definitely much more subdued than from the credit side. But here it might be not a bad thing. What I'm trying to say, if for the countries that have deeper and more diverse local investor base, it might be even almost preferred to have them dominate the market than foreign investors. And as my colleagues here mentioned, a lot of QE was put in order to facilitate functioning of the local markets. And if you remember the old-fashioned literature on the opening of foreign exchange markets and then having freedom, well, from trilemma it's turned into dilemma, as Ellen Rain put it. When you have a lot of foreign investors in your local markets, you might not have the same freedom on the monetary policy front. And I think that's probably what motivated some of the central banks to intervene into local markets, because what they saw is that and again, I'm sort of speculating because some of the central banks are here. What they saw is that the effectiveness of their transmission monetary policy was diminished by exit of the foreign investors from their local markets. And of course, to talk about financial sector depth, it doesn't happen overnight, but of course, high inflation credibility that all the central banks here and many of the central banks here in the seminars have definitely should help development of the local markets, as well as legislation and facilitation of the insurance and pension funds and mutual funds that are present domestically and can be the natural investor base for the local markets, rather than just reliance on the foreign investor base. What is interesting, however, in this crisis, and hopefully will continue for the monetary policy and the local market interaction, is that if in 2008 and also during the taper tantrum, we saw pressure coming for hikes from the implied yields. So you could see sort of the pressure from external pressure, either via implied yields on the currency or some sort of external pressure, and then of monetary policy following that. Now, actually, in this crisis, this pickup in implied yields was very brief. That is also a signal of more central banks sort of going fully fledged inflation targeting, away from the sort of using exchange rate as an intermediating factor, and also probably more credibility of from the global investors that they don't have the sort of, you don't have the spillover from the foreign exchange market to the monetary policy as much. More recently, we've seen some pickup in countries, sort of pressure on the FX, but it's definitely something that needs to be watched going forward. And why? Because we talked here early on in COVID, we were so worried about having pressure on balance of payments needs, what can happen, does the IMF have enough money, we need emergency liquidity support, and very quickly those discussions sort of faded out. Why? Because there appears to be very little pressure. We need to step back and think, what do we believe was the reason behind that reduction in pressure? Is it because of the COVID lockdowns and imports came down, and that's something that as economies recover will go away? Is it because of maybe commodity prices? Again, that's something that maybe another year it might start going away as well, meaning positive terms of trades. Or also, is it because of the extraordinary support from the developed markets, and that very quickly removed the pressure on their balance of payments? Again, for now, most countries feel comfortable and they don't need to worry about that. But going forward, the shocks to external side should not be fully ruled out. And sometime next year, year, we might start maybe towards the end of the next year, we might start having an eye as well on the external balances and the balance of payments pressure. Especially as of late, we have seen a pickup in dollar and sort of strength, dollar strengths that can have an impact on emerging markets as well. So with that, I will finish my presentation. And we can open for questions, and I'll pass it back on to our fantastic moderator.
Okay, thank you. Thank you. Thank you all. You have been very disciplined with time. I now open floor to the questions. Please, when you ask questions via the question and answers, just indicate to whom you want the question to be addressed. And I already have one question for Csaba. It is a question by Andrew Blinov, and I will read it for you now. So please, Csaba, listen carefully. Could you give the details of short-term bill Hungarian National Bank has introduced since November 2021 as an instrument of monetary squeezing?
Thanks. Okay, I can try to give details. Of course, we are not using it. We are introducing, and we will use it in the end of quarter. And it will be a special instrument because we had the phenomenon that the FX swap yields, the FX swap implied yields of in Hungarian forint is at the quarter ends is usually lower than the interbank rates and the policy rates, what the monetary council deems optimal. So that's why we are using already FX swap instruments at the quarter ends. We use it in the last couple of quarters as well, and we are, of course, we are already announced that we will use this FX swap instrument in the end of the year. But we had the experiences in the last quarters that this FX swap instrument, of course we should use foreign exchange reserve to withdraw the half liquidity at the quarter ends, and we are trying to use now another instrument as well, this new bill to also absorb liquidity, and we have the discussion with the commercial banks, and they are, of course, they are already asked their clients that whether they could use it to lower the liquidity supply in the market in the quarter ends, and that was a consensus between us and the commercial banks that can help. Of course, it won't be the only liquidity absorbing instrument. It will be a limited tool. We will use our normal policy instrument is the 1 week deposit. We will use that one unlimited. This new bill will be limited, but I think it will have at the quarter end, and we use it only at the end of the quarter, so it won't be a continuously used instrument. I hope that's enough. We are still in the phase of working on the operational details, so I think that's the framework I can share with you now.
Okay, thank you. For the time being, there are no additional questions from the floor, so please, we still have some minutes. Let me abuse my position and ask the panelists if they would like to comment, maybe all of you or somebody, on the following issue. I'm fully aware that this is about monetary policy and inflation targeting in emerging economies, and we are talking specifically about reaction to pandemic. But as Elina rightly mentioned, I mean, a lot of things in economics are changing. And by this, I mean, you spoke about old textbooks, and I agree with you. What we learned a couple of years ago, it's not always valid anymore. Let me be specific on one issue. And this is something that has been going on before the pandemic, but in my view has been speeded up, and this is the digitalization of finance in general. What the pandemic did is actually put this digitalization, as I like to put it, on steroids, because everything exploded. It's not just the balance sheet of central banks. And here I'm referring just very briefly to all the topics that you are well aware. I'm talking about cryptocurrencies, stable coins, about decentralized finance, about blockchain technologies, and so on. Central bank reaction was, among other things, my understanding is that they were afraid to some degree that they will be crowded out. So the monetary policy will be less efficient if you allow all those crypto assets to continue. And one of their reaction is they started working on central bank digital currencies. So that is my comment, and I would really appreciate your notion on how do you see the future, could be future in a couple of years, though we already know some central banks already do have the central bank digital currencies, but will it affect monetary policy, emerging markets, to what extent, and so on. So please, who wants to start? Okay.
I'll start and then I'll pass on to people who actually know. So on the, I did have CBDCs as on my sort of speaking points list, but then I thought maybe I should keep to my 15 minutes. No, I think that is the most important development, as you say, put it on steroids. And why is it an important development? Because it's technical and relates to plumbing. And a lot of people sort of ignore that. They think, you know, they hide behind big names and they don't focus on the details. Of course, not the central bankers, but the analysts. And I think this is exactly when the issues happen and the market tends to ignore something extremely important. And the reason I say that, because I think it will alter the way that we think about the monetary policy. It is a new form of money. It is not something the central banks are not familiar with, and I think that I'll definitely see the central bank is very much in charge of this agenda, because it is just another way of money. And as we remember, the unit of value, you know, sort of exchange, it goes exactly to those points. It also affects the payment systems as well, and we will have a long period when the payment systems will have to coexist. And it's not that we've jumped from old regime to the new regime and then there's a new textbook and we know what to follow. No, you will have this mixed regime, and we will need to think how the wholesale payment system changes, how the retail payment system changes, and how that affects our monetary policy, and write the new books. But I do definitely think that this is a critical new area. And so at the IF, we're also trying to have a few sort of central bank discussions, informal discussions internally, where we exchange ideas on this topic. So it's like a, you know, like a safe space to discuss, and I know BIS is doing some of that work as well. And I think that is definitely a critical development going forward, but not something that central banks cannot deal with. I think they're the best place to deal with this.
Still muted. Sorry, I was muted. Dimitar.
Yes, just I also want to comment on this question. It's a very interesting, very hot topic at the moment. My view is a bit conservative, but I'm for the old school thinking that there should be only one sovereign issuer of money in every country, and that is central bank. So money can be issued by central bank. It's good, the approach that central banks took to research this area, to experiment with digital currencies, because this is the future, and central bank has to keep the monopoly on this issuance of money. What we saw so far as cryptocurrencies by different issuers, not central banks, I cannot characterize as money, because they're not used as mean of exchange. They're used just as asset classes. Asset class, another asset class, and that is not money in the pure terms.
Thank you. Any other comments? Yes.
Okay,
Yes.
I also say a few words. I mean, I think it's quite clear that for all of us that CBDC will affect how monetary policy is working, sorry, also how financial stability is working. In Poland, we are kind of monitoring, observing, analyzing, but probably we will not belong to the first movers, predominantly because I mean, what is important is, of course, also the interaction with the already ongoing payment system. And in Poland, in fact, we are quite advanced in those cashless payments mode. As you mentioned, I also work at the ECB, so I was also living in Germany for a few years. So I can also, based on my personal experience, say that we are kind of quite advanced in those digitalization. I mean, at least regarding the personal payments. So probably, as I said, Poland will not belong to the first movers in that respect. Thank you.
Yes, please, Csaba.
Yes, I think it's a really new but really important topic for central banks as well. So our central bank as well, and I think the majority of the central banks are investigating the possibilities of these digital currencies, and I think we could see this as a opportunity for the future. So I think that's really important. We had the experiences to have really targeted tools in the past. We try to use loan facility for the SME sectors and other tools. We try to we could see the problem which sector had bigger problem or lower funding, and we use targeted instruments for that. And I think the digital currencies can also have a targeted usage in the future. So I think we should concentrate on the experiences of others, and I think there are some central banks who are really far in front of others, and we are really closely following those central banks that what their experiences are, and I think it will be part of the future toolkits of the central bank. So it's important. Thanks.
Okay, thank you. I see one more question, but before I ask them, let me just briefly say what I've learned in a couple of days. There are already a couple of banks that introduce central bank digital currency. It's East Caribbean Monetary Union. They have 8 countries, 4 of them are using it. Bahamas, which is, as you know, a small island country, but Nigeria. End of October, Nigeria, the most populous African countries, introduced e-Naira, and we'll see what the results are. What I'm looking forward is the next Olympics, Winter Olympics in Beijing, because China announced that it will have its digital currency, digital yuan, ready for the Olympics. So let's wait and see what happens. Now, the next question is from Rustem. He didn't specifically say to whom to address it, so I'm asking whoever wants to jump in. And the question is, what do you think about current taper effect difference from previous taper for emerging markets? Okay, so what's the difference between the taper that happened before and the taper that will take place now? Elina?
So from our side, of course, it's hard to forecast. What was forecast the previous crisis, but what I think the taper is different, at least from the shocks that we have seen now, is that for borrowing and foreign exchange credit, we see much less of a reaction to the global factors than in the taper tantrum. And the taper tantrum, it was behaved like the same very volatile emerging market, high risk asset class. While the recent shocks, COVID or early in the year, sort of this effect has diminished over time. That's what it seems like. It is possible because of the mitigating factors that we talked about, lower balance of payments risks, and maybe that sort of compensated. And my story about emerging market asset classes, much more mature asset classes, is out of the window. But at least this is what we see empirically. For the local markets, we haven't seen the return of flows like we have seen in the past. But what is very important, and I was looking at the share of flows to GDP in some of the countries recently, just to scale it. And to me, it was surprising that they've become the local flows, although as an aggregate, they haven't returned almost since the taper tantrum. But if you look at the country specifics, they are very large share of GDPs in some countries. And these countries, Brazil, Egypt, you know, it's surprising that that the swings then can have a much more significant effect. And here's the question where the domestic market depth can meet those flows. So for example, if it's South Africa and the flows are pretty significant percent of GDP, but then their domestic financial system is more than 200% of GDP. So again, then the local investor can easier absorb those swings. But of course, if you're Egypt and there are smaller and very few concentrated banks working in local market, then the foreign investor flow of almost 4% of GDP is significant for your monetary and fiscal policy.
Okay, thank you. Yes, Csaba, please.
Thanks. I think I agree with Alina, and I think there is really big, can be really big differentiation. And in Hungary, of course, we had a bad experience in 2008. So we had a experience which we can build on, and that's why in the last 10 or 12 years we tried to stabilize our financing, and especially the government financing. And as Alina said, that it's important for us that we had a much more distributed financing sources. So we try to involve the households directly. I think that's a more or less unique one. So we had one fourth of the government that's financing is financed from directly from household securities. It's not a cheap source of funding, but it's I think it's much more behave different way than the international flows. So that can be a sort of insurance in hard times. And the other thing that we try to decrease the FX share of the financing of the government debt. And of course, we try to increase and motivate the commercial banks to increase their share as well. So we have now quite equally distributed debt between the non-residents, the commercial banks, and households. So it can help, I think, in times in harsh times to have lower outflows. But the other thing is that is true that the sound and prudent fundamentals are crucial here, I think, in these times. So that's okay. An easy answer to that.
Okay, thank you. What I promised to the panelists is to give each of them at most 60 seconds for final thoughts. You can steal a car in 60 seconds if you watch movies. So in reverse order, Elena, what are your final messages?
Well, you stole my final message on digital currencies and digitalization more broadly. So I will talk briefly about the balance of payments risks. We forgot about them, but they're not completely out of the picture. And the dollar is strengthening, so let's not forget about they can return.
Okay, thank you. Csaba.
Thanks. I think what is crucial message from me, I think that the flexibility of the IT is really useful in crisis times in both ways. So going in the crisis and coming out of the crisis as well. And I think the targeted tools can help a lot. So I think it's really useful for the central banks if they try to use tools to specific sectors or specific economic area. And the third is that we try to stabilize our financial markets and try to build financial markets as the mortgage bond, as the commercial corporate bond market as well. We try to build those markets. And a final advertisement from us that we have a digital currency study published this year. So that's our, I think, our contribution to this really important area. That's my final thanks.
Thank you, Dimitar.
Well, central banks in emerging economies played quite well during this crisis. I would say that even after the crisis, the exit so far is also quite fair. They started with raising rates quite early in the cycle of rising inflation, judging by the countries in my region, Eastern Europe, but also Central Europe. Central Europe started a bit later than Eastern Europe, but they started and they're on the right way. So they are going to keep inflation under control, and this is good. So they're returning their policies to the normal. But going forward, next year, attention should be paid to tightening on the international financial markets. Normalization of monetary policy in advanced economies will inevitably lead to tightening of the financial markets. And this is a risk factor that emerging economies should have in mind and be quite aware of it.
Okay, thank you. Last but not least, Joanna.
Yeah, I hope you can hear me now. Yeah, I will be very brief. I just wanted to say that as we all see now, those unconventional measures are part of our policy toolkits also in emerging market economies. And even before we learned to use them, monetary policy for many observers was complex. Now it's getting more complicated. And what I think is crucial also going forward is the right communication aimed at really keeping or safeguarding or restoring the credibility of our monetary policy frameworks, including, of course, inflation targeting, for which credibility is really crucial. Thank you.
Okay, thank you. This is the end of our session. I guess I share your views that it was a fantastic 4 panelists, very diverse opinions. We shared a lot of different views. I really enjoyed it. And I don't know how to ask for applause via Zoom, but I guess I'm sharing your views. So, dear Sergey, the floor is back to you.
Thank you very much. Thank you very much. It was indeed a fantastic panel. Thanks a lot for Marco, for you, first of all, as a moderator, and I agree with you to 4 fantastic panelists. So now we have the break, and let's come back in half an hour at 4 o'clock in Ukrainian time, and definitely I can't say how many time zones we have among our participants during this workshop. So please come back in half an hour. Let me announce reopening of our research workshop and pass the floor to Carly Smith, who is the chief economist and the project of programs of economic policy in Eastern Europe, covering Belarus, Moldova, and Ukraine, of the World Bank. And so this panel will be devoted to the issues related to the current surge in inflation around the world, and with special focus on emerging markets. So, Carlis, please, the floor is yours.
Thank you, and thank you for the invitation and having this important topic. I'm based in Kiev, and unfortunately we are meeting online, but we can make a benefit of exchanging views here on this challenging topic. We're going to talk about policy responses to the current surge in inflation, which is not a challenge not only in Ukraine, but in other countries. And the central banks are facing a multiple of policy instruments, and obviously inflation targeting is one of them. Today, we're going to hear from the 4 speakers, and then it's followed by questions and answers. Each of the speakers would have about 15 minutes, and then we'll have a follow-up 7 minutes each for questions and answers. This is supposed to be interactive, but we'll start with the first speaker, Archil Mesrishvili from the National Bank of Georgia, to share some of the experience in policy responses to a current surge in inflation in Georgia. Archil, the floor is yours. Thank you.
Hi, everyone. So let me share screen. I'm very sorry, I had some problems sharing.
Yeah, we see the screen if you put it, yeah.
Yeah. Can you see the slideshow?
Yeah, we can see the slides. Can you put this kind of on a kind of a full screen? It's a little bit bigger, yeah. Like.
Sorry. Is it okay now?
Yeah, no, it's perfect.
Sorry, I try to avoid these problems, but so let me talk briefly about our experience and how we react to inflation spikes in different periods, and especially for special focus on the recent one. So this is point, and it's way above target. Our target is at 3%, and you can see that core inflation, it's pretty high as well. So we had spikes in inflation in different period. In 2011, our inflation reached 14%. It was slightly above the 14%. And I will come back to this slide in the end. I will try to compare 2011 and current period. But we also can see that spike in 2017, where because of the excise taxes, inflation overshot the target significantly. So at that time we did not tighten, we just tightened moderately, and we explained this is a temporary. And then inflation went down to the target again. So we had a similar case in 2019, where after Russian embargo, exchange rate depreciated, inflation spiked, but that time we tightened monetary policy, and then inflation went down to the target again. So we have these spikes, but the latest period is maybe most interesting now, and I will try to focus on that. So response to inflation spikes depend on monetary policy, but also the credibility of the central bank have. So inflation targeting allows you to deviate from the target temporarily. So if you have high credibility, you can allow this large deviation, and you know that it will not translate into inflation expectation, and inflation will return to the target where these transitory factors will be excluded from inflation. But if you don't have enough credibility, or if instruments are not well developed, or you have high dollarization like we have, so then you need sometimes to react to supply side factors as well, not to allow inflation expectation to rise. So we have inflation targeting since 2009. We developed it gradually. After 2013, we have FPAS, and I have seen David Vavra. He helped us with creation of inflation targeting framework, but also with FPAS. Since 2016, we improved communication, improved transparency. We start publishing policy rate paths. And we have floating exchange rates. We intervene time by time, but it's more or less floating. So little bit about the current shock and its impact to Georgia. So the pandemic kind of wiped out travel worldwide, and we were significantly dependent on external tourism from tourism expert. So in 2019, almost 12% of our GDP was tourism export, and it went down to 2%. So in 2020, we lost 10% of our GDP as current account inflows. And in 2021, there was some pickup in tourism revenues, but still about 8% of GDP we lost again. So this is external revenues and external demand. For domestic demand, we had the opposite. So because of pandemic-related lockdowns, the government tried to compensate to the companies or households who have suffered because of that. Also, where our tourism sector hit a lot, the government tried to compensate HoReCa sector and healthcare-related costs. So because of that, our fiscal deficit increased to historically highest 9.3%. And in 2021, it's 6.7, also very high. And in 2022, it's expected to be 4.4%. So we lost external demand, but we have, through fiscal, some economic stimulus, which for the exchange rate, it means, of course, depreciation, and that is translated to inflation through different channels. So first channel is a direct impact to import prices, and the second channel, in our case, is dollarized loan book for corporates, where their cost of the debt service increase. They try to transfer this to inflation. For banking sector, because there was a demand for higher liquidity, we provided liquidity based on different sources. So there was no liquidity shortage. So we allowed banks to use some of their capital buffers. And we also asked them to apply loan loss reserves in advance. So the banks had enough capital to increase lending. And also we expanded monetary program with the IMF, and the government borrowed in foreign currency. So we had some funds for additional interventions. So in the end, we had negative net export, but in general, our drop in GDP was compared to the losses we received from the pandemic and from the tourism, it was more or less okay. So it was 6.8%. So this year we expect 10%, and next year 5%. So for the growth, we went through it pretty well. But again, so we lost our external demand. But when you have high dollarization and you are losing external demand and exchange rate depreciates, then during the dollarized environment, it's a double shock. You need to tighten domestically. But fiscal was expansionary, so we had to tighten through monetary policy. So it was not for combating inflation, but more or less to counter fiscal expansion and to contain some of the fiscal expansion we had. So in the end, in 2020, the aggregate demand was negative, and this is because of the external demand. So it was pushing inflation downwards, but exchange rate was significant, and supply side factors related to pandemic and pandemic restrictions as well. So in the end, 2020 was, on average, inflation was about 5%, still much above our inflation target of 3%. So we came to 2021 and spike in global prices with higher inflation in 2020. So the biggest problem of the policymakers while reacting to supply side factors is to avoid the second round effect and avoid to build up inflation expectations. So when you have inflation one-off, transitory, then you can go through this without creating inflation expectations. But if you have high inflation for a long period, like we had starting from second half of 2019, then in 2020, and now we have the supply side factor. So that's the risk that it will induce inflation expectation, and then inflation cycle will start. So even though exchange rate impact recently is much diminished and exchange rate has appreciation path, still we have high inflation, and we try to have tight monetary policy to make sure that the spike in inflation is temporary. And this is our forecast for inflation, which shows that we are not in the peak yet, so the inflation will going to increase because of the base effect, and then from the second quarter of 2022 it should start to decline sharply. This is also based on the assumption that we will tighten monetary policy a little bit more, and then we will be able to ease monetary policy. So why we are doing again? So we are afraid of inflation expectations to emerge, and our inflation path assumes that inflation expectations are increasing. So aggregate demand is neutral. Before it was negative and was balancing some of the supply side factors, but now it's a neutral, and inflation expectations are rising, and we see from different data from different surveys it's still more or less okay so far, but we also keep tight monetary policy. If we did not have tight monetary policy, and our policy rate is now 10%, historically highest, then we might see more inflation expectation. So for the future, there is a risk how inflation will develop. So inflation in Georgia through supply side comes from global commodity prices. We import lots of food, gasoline, but it also impacts our exports. So some of the agricultural products which we used to import before, now we are exporting because of the price has increased in the neighboring countries. And also the transportation cost increased several times, so it puts pressure on imports, but also affects our exports. But we don't know how long it will continue. So we hope it's temporarily the supply will adjust, the transportation will adjust, this peak in demand will go away, and then after this one factors, supply side factors will be removed from inflation, then inflation will start to decline fast. So now we are going back to our experience. What we had a similar case in 2011, where on the global commodity prices, we had a similar picture what we have now. Of course, there was no COVID that time. It was just bad harvest. Now it's maybe more difficult, but on the global market, it's more or less picture is similar. So what we did in 2011, even though our core inflation was pretty low, we have tightened monetary policy significantly. We increased policy rate from 5% to 8%. At the time, it was significant tightening because fiscal was modest at that time as well. So we over-tightened that time. And later stage in 2012, 13, we had negative headline inflation, which was okay because of the base factors, but core inflation was also negative or close to zero. So over tightening also means that you have loss of GDP, you have deteriorated some of the wealth when you do over tightening. But if you don't have enough credibility, then the only solution is to tighten a little bit more to avoid inflation expectation. So this is a risk now we have here again. So we are tightening, we have high fiscal, we have this pandemic continuing. We have tightened our monetary policy to 10%. So are we doing over tightening? So this is a risk now we have. So if we over tighten, then we mean that we have lost jobs, GDP, and so on. So it's very difficult now to say how long this pandemic will continue, what will be impact to inflation expectations. So this is where we are right now. So that we'll have the next policy meeting in a couple of weeks, and then we'll decide. We might little bit tighten more, just to make sure that inflation expectations are contained. And if we see that this global surge in commodity prices reverse, then we're able to ease. Or if we see, even if it's prices stop to increase, it's also helpful for our inflation to go down. So this is very briefly what is our thinking, where we are, and what are the policy thinking behind our decisions. So again, we have tighten monetary policy. We have 10%, which is very high, but we also have high fiscal and inflation expectation. So this is briefly, but just one more issue. So in terms of our policy credibility, we used to do well. So on average, before like a recent surge, if average inflation since we moved to inflation target, it was 3.5. So it was okay, but again, because inflation is above the target for a long time, and because this shock is very strong, now we think that we might need to be biased to more tightening than it's otherwise would be advisable. So this is where we are different from advanced countries, where they say it's transitory, it's okay, we are not going to tighten, or tightening is modest. Thank you.
Thank you, Archul. It's a very good overview. Anybody, we have some time for questions. Anybody in the audience can raise a hand, and if not, I'll have a question to Archul. I don't see any signs. If nobody's, I'll start one question that you Archul mentioned. One of the kind of difference between, well, the uniqueness is that you have very loose kind of a fiscal policy, and part of the reason why you kind of over tighten is because of the loose kind of fiscal policy. The other thing is you mentioned that the inflation expectations are kind of also kind of building up. What happens to the kind of a wage bill? Part of that fiscal not stimulus, but expansion is also kind of an increase in public wages. Or what is the kind of composition of that fiscal expenditure? Because in a lot of countries, the key channel is through increasing sort of minimum wages or wage bill in the economy, which again builds up to the inflation expectations and also kind of to aggregate the problems. Thank you.
Yeah, thank you for this question. So before 2022, before the next year, the increase of the fiscal was driven by additional capital spending and COVID-related expenditure. And from 2022, there will be 10% increase of the wage bill for government sector. So the private sector was, even though the employment went down, the wage bill in private sector increased in 2020 and 2021. But in government sector, the fiscal deficit was not driven by the government current expenditure. It was driven by the capital expenditure, and there was some projects which were started before 2018, 2019, which peaked in 2021. So they do not want it to slow those capital expenditures. These are like main roads, and which end up in fiscal stimulus through capital expenditure, but also COVID-related expenditure, which was a compensation, and healthcare that was around 3% of GDP from 9% of fiscal deficit. So we used to have below 3%, and then it became 9%. But out of this 3% was COVID-related compensation and healthcare.
Thank you. And we have one kind of a question from the chat, which is from the participants. What's the extent of Georgia's kind of recovery from pandemic? Where do you see your economy? Are you above potential, or you're still kind of below the potential? And how does that kind of guide your policy, monetary policy? Because I think the growth was about 10%, but where do you see kind of in your relative to the potential? Thank you.
Yeah. So because of pandemic, we also assume that the potential level went down. So in 2021, we are slightly above the potential level. And in 2022, we will be close to the potential level. So in 2020, we were below, but in 21, we are at potential level, above the potential level. In 2022, we'll be close to the potential GDP.
Yeah. Thank you, Angel. We'll have to move to the next speaker. Thank you for experience in Georgia. Hakan Kara used to be a chief economist at the Central Bank of Turkey. Currently, he's in academic position. But Hakan, it would be good to see what challenges. I mean, Turkey faces a lot of challenges these days. It's all over the news. But in a sense, let's focus on inflation challenge and what has been policy response and strategy. Thank you, Hakan. I think you're still muted.
Thank you, Carlos. Can you hear me now?
Yes, we can hear you.
Okay. So this session is about response to inflation. But right now, Turkey is not responding to inflation very rigorously because we are kind of experimenting with a different policy, which is kind of a current account deficit targeting. So in that sense, I thought it would make more sense if I pick a more general topic and talk about how the inflation dynamics in Turkey has shifted in recent years as the inflation anchors, the expectations are disanchored. So that's the topic of my presentation. And at the beginning of his speech, and on the opening speech, David said that unless we hate what we are not, we cannot love what we are. And I think after listening to this presentation, the countries will love what they are as inflation targeters, because Turkey has kind of abandoned inflation targeting in recent years and started doing more multiple instrument, multiple target framework. And the focus has been shifted more to growth and the current account deficit. So I will explain how the inflation dynamics and expectations have changed through time. I will first talk about the evolution of monetary policy in Turkey, and then I will touch upon the issues on how this is reflected on the behavior of inflation expectations and changing inflation dynamics. If I have time, I will also talk about the recent developments, because I'm sure that everybody is curious about what's going on in Turkey. But if I only have time, otherwise we can talk about it in the Q&A session. So let me just briefly summarize the evolution of monetary policy in Turkey. It starts in 2001 with the financial crisis. Turkey had its deepest financial crisis. The central bank law was changed, and the central bank has adopted implicit inflation targeting because the law granted the instrument independence to the central bank. So at that time, we have implemented a light version of inflation targeting. And that was successful, actually. Inflation came down to single digits. So encouraged by this success, we went with the full-fledged inflation targeting in 2006. But after the global financial crisis, the global financial conditions started dominating the domestic economy. And we started thinking about, how we can modify the inflation targeting framework so that we can put more emphasis on financial stability. And then so after 2011, I can describe the whole framework as incorporating financial stability into the inflation targeting framework, this is when the focus started shifting from inflation to financial stability issues. But between 2011 and 2016, it was fine. I mean, the central bank was still targeting inflation, but we had multiple tools in target. The central bank and the other authorities were jointly using the macroprudential policies intensively to manage some intermediate variables like credit and exchange rate in order to target additional variables such as financial flows, current account deficit, or the leverage in the economy. But still, the central bank was, adhering with the rules of the inflation targeting at that time. But things started changing after 2016. After 2016, we had a couple of shocks: geopolitical shocks, Syrian war, and then refugee influx, and the coup attempt in 2016, the domestic political uncertainties. So the perception towards Turkey has shifted, and we started having capital outflows. And when you have the capital outflows, the trade-off between inflation and output worsens. It gets worse. So the authorities made a decision in 2016. That's an implicit decision saying that they will focus on growth and the current account deficit, and inflation will be as a secondary objective. So that rhetoric on the competitive exchange rate was presented, and since 2017, Turkish lira has depreciated a lot in real terms, because it seems like the authorities want to grow, and in fact we grow. I mean, during the pandemic, many countries have contracted. Turkey was one of the rare countries that posted positive growth during the pandemic. But that came with a cost, as I will show you. The bottom line is that the emphasis shifted to growth and external balance. So the authorities want to grow, but they don't want to create a current account deficit. They don't want to be dependent on external flows. But then if this strategy is the predominant strategy, then the inflation is sacrificed, because all the burden falls on the exchange rate. You have to let the exchange rate depreciate. And then the focus shifts from inflation to growth and external balances. Just look at the real exchange rate between the first decade and the second decade. So you can see in the first decade, Turkey was the most appreciated currencies in real terms. But in the second decade, Turkey was the Turkish lira was the currency with the most depreciated compared to major emerging economies. And that's a big contrast. And that also shows the preferences, the shift of the preferences after 2011, and especially after 2016. One thing that I should mention is at the background, the central bank independence has changed a lot because during the inflation targeting period, I mean, the terms of the governors were 5 years, and the governors survived 5 years. But in recent years, you can see that the terms of the central bank governors started to be getting lower and lower, which, I mean, this picture just explains what's going on. Actually, the central bank operational independence has been depreciated considerably. And that's why we're having the recent problems, because the central bank is not able to decide on the monetary policy itself, and the government is forcing for more growth. So that's the main conflict that the authorities are having now. And this monetary policy is basically now at the driver's seat of the monetary policy. Right now, there's a presidential office rather than the central bank. And not surprisingly, the inflation started going up after 2017. Before 2017, the inflation was averaging around 8%, still not reaching the targets, but above, but that was reasonable. After 2017, we have seen a big shift in the inflation process, both in terms of volatility, but also in terms of the level. Looking at the targets versus the inflation, you can see that in recent years, the targets were breached by a large margin. And not surprisingly, the degree of anchoring of the targets have diminished through time. And the inflation expectations responded. After 2017, we had a big surge in inflation expectations and very volatile inflation expectations, both survey-based and also if you look at the distribution of inflation expectations, this is the probability distribution of expectations taken from the surveys. You can see that the distribution has been pretty diverse, and recently this yellow part is getting larger, which means the probability of inflation getting above 15% in the next 12 months is getting larger and larger. And it's not, again, surprising because the central bank started cutting interest rate recently. The inflation uncertainty has also increased considerably. We have some studies measuring the inflation uncertainty by using different techniques, and whatever technique you use, you can see that the uncertainty of inflation has shifted considerably after 2017. So the question is, whether this framework has changed the expectations dynamics. And we have a recent study actually looking at whether the inflation expectations are anchored or not. One way to look at whether the inflation expectations are anchored is to look at whether the inflation surprises are having a significant impact on inflation expectations. So the chart on the left-hand side just shows the response of inflation expectations to inflation surprises. And the response is relatively muted. So the slope of this curve is very flat, but you can see that after 2017, how the expectations becomes much more responsive to inflation surprises. So the expectations are not anchored anymore. That's also true for the exchange rate reaction. This chart also looks at the impact of the exchange rate on inflation expectations. And you can, in an inflation targeting framework, you wouldn't see much relationship between exchange rate and inflation expectations, because if people expect the central bank to react to the exchange rate fluctuations, then the correlation between inflation expectations and exchange rate should die away. And that's what happens in 2016, 2006 and 2016. But after 2017, you can see that there is a very strong relationship between expectations and exchange rate. So it seems like any movement in the exchange rate is reflected to the inflation expectations. Recently, we have a study published in the International Journal of Central Banking, which we surveyed the inflation forecasters. So we asked the professional inflation forecasters, what is driving your inflation forecast? And then ranked all the variables according to the most important to the least important one. And you can see that here the inflation target is ranked the least. So people just don't look at the inflation target anymore. And they don't even look at the central bank inflation forecast very quite carefully. So that means the anchors are lost, as I mentioned in the topic. So the second question is whether this loss of anchoring has manifested itself in the changing inflation dynamics. I mean, we know that the expectations are deteriorating, but what about the inflation dynamics? In order to understand what's going on with the inflation dynamics, we just set up a couple of models, time-varying Phillips curve open economy models, to see what is the impact of the exchange rate on inflation and how does it change through time. So we estimated time-varying parameters. So this is the result I mean, I have many parameters, but I don't have time to show them. I just wanted to show the coefficient of the exchange rate on inflation. You can see that the pass-through from a 1% change to the exchange, to the inflation, was around 15 basis points. So 15% pass-through in 1 year, but then the pass-through started shifting up and up after 2017. Again, not surprising, because as the economic agents see that the central bank and the authorities are not responding to the inflationary pressures very vigorously, then the exchange, the shifts in the exchange rate are perceived more permanent, and the price setters feel more comfortable to pass it to the prices. This chart is showing the lag structure of the exchange rate pass-through. Again, each color shows a different quarter. So this just focus on the color at the bottom, which is the dark blue line, that shows the contemporaneous response of the inflation to exchange rates developments. You can see that after 2017, the contemporaneous response of inflation to the exchange rate has shifted up, and it has almost doubled. We can also confirm this evidence by structural VAR estimates. This is showing the accumulated impulse response to a 1% shock to the exchange rate. You can see that the red line shows the period between 2005 and 2016. The accumulated pass-through was around 15%, and the pass-through was completed around 15 months. But look at the period where we include the last 5 years, where the inflation has deteriorated. When you include the high inflation period, you can see that the accumulated pass-through has increased. Not only increased, but it's also faster, because the accumulated impulse response is almost completed in 6 months. So there's a significant change in the inflation dynamics. So far, I just tried to show you that the change in the expectations and the change in the behavior of the authorities are affecting the pricing behavior of the economic agents. And once the inflation anchors are lost, then the central bank is having this spiral between exchange rate expectations and inflation. Do I have time, or I should skip the most recent development?
I think let's kind of have, for interest of time, let's maybe like ask some questions, and then we obviously one of the questions might be in the most recent developments. Hakan, there is this one in the chat.
Then let me just conclude then, Carlos, just very quickly. I just want to say that the Turkish experience demonstrates how the inflation process can shift quickly when the central bank credibility is damaged, and the loss of a nominal anchor leads to the behavioral changes and expectations. So my main message to the central banks watching us is that the credibility is a precious asset, and take good care of it. Thank you.
Thank you, Hakan. There's this one question in the chat box, which is kind of a little bit technical, but it might be easier to do it here, or you can have a chat. But how do you measure inflation surprises?
We just look at the realized inflation and the expected inflation. So the difference between expectations and the realization is the surprise from the.
Okay, so Hakan, it's obviously the big interpretation. Quick question on my side, also kind of how do you see the current developments? And I think the way how you frame this is kind of, it's impossible to do kind of inflation targeting when you don't have an independent central bank, I think. But how do you see the current events, what is happening, and the role of the kind of a central bank? And it's not only in Turkey, this issue about the independence of the central bank is quite relevant. But how do you view the current development in given that kind of a role of the central bank? And as you said, like this credibility of the policies, which is very difficult to get it back once you lose it.
Yeah, thank you. Let me show you one more graph then, because can you see my screen?
I can see. Thank you for your kind attention. Yeah. Okay.
Just let me show you one picture. This is the changes in the central bank policy rate in the last 6 months. So that's the major emerging economies. And then you can see that almost all the emerging economies are on a tightening cycle, whereas Turkey stands alone on the right-hand side. So that's I'm concerned about this experiment, because the central bank is cutting interest rate when the inflation is rising and the inflation expectations are deteriorating. And if you just look at for example, the real interest rate, which is this red line, the real interest rate has been going down and down and down, whereas the average real policy rate in the emerging economies is tightening. And my concern is that as the central bank refuses to respond to this situation, not the central bank, but basically it's the authorities anymore, the inflation will continue to increase. And then we will have lower and lower real interest rate, which will create more dollarization because people just don't want to invest in Turkish assets. So at the end of the day, I mean, the situation will get more complex. and we may run into more unconventional measures through time. And no wonder the Turkish lira is depreciating sharply in recent period. You can see that Turkish lira is just on a free fall in the last couple of weeks. And the authorities are claiming that they want to correct the current account balance. And as the current account balance is corrected, that will stabilize the exchange rate. But the problem is that it takes time. So there's a lag between the exchange rate and the current account balance. And also, you cannot avoid this, this spiral. You have this unjustified rate cuts. Lira depreciates, inflation rises, that feeds into expectations, and in the absence of a monetary policy response, the real interest rate further goes down, the risk increases, and again, you have another round of lira depreciation. So the problem is that right now, there's nothing to, the only way to break this cycle is the central bank stepping in and just tightening monetary policy. Otherwise, Turkey may have to implement other measures like constraining the FX transactions or whatever. But as long as the interest rates are at the wrong place, all the other attempts will prove temporary or ineffective, I think.
Yeah, thanks. Hakan, maybe we're short of time, but I think one last kind of a question, and if you short answer, there are three questions which have a similar thread. In a sense, yes, Turkey kind of has this kind of inflation is kind of a missteps in the monetary policy, but a lot of people say that the bottom line is that growth is still delivering. I mean, the Turkey is one of the few countries which grew in a sense. How do you see, how to realign this kind of paradigm? Is the growth real? What happened to the incomes? How do you align these kind of two paradigms? Thank you.
I think they are not conflicting, because the issue is there's a trade-off between inflation and output, and we see that. And so Turkey just picked growth. Last year, there was a massive injection of credit into the system through public banks and through the credit guarantee fund sponsored by the Treasury. We had enormous impact on the domestic demand. And with the recovery from the pandemic, the exports were also doing well. And in total, we had a positive growth. But that is accumulating some imbalances. The inflation is now 20%, and it is expected to increase more. So in the future, actually, there will be a cost of bringing inflation down. So what we are doing is now we are borrowing from the future growth right now.
Yeah, thank you, Hakan. Fascinating,
Sure.
President. If you have a chance, there's a few written kind of questions for you to answer, kind of maybe like if you have a moment in a chat box on the capital controls. But thank you for your presentation. We'll move to Vladimir Lebeshinsky, who is kind of a director of the Monetary Policy and Economic Analysis Department, to focus on Ukraine's NBU's response, consistency, and predictability in a highly uncertain environment. And obviously, Ukraine also faces a few challenges in terms of both growth and also high inflationary pressure. So, floor is yours, Vladimir.
Thank you. Actually, can you hear me?
Yes, we can hear.
Yes, good. So I will share my slides.
And we can see you.
Do you see the slides?
Yes, we do see that. If you can make them a little bit bigger, yeah.
Okay, good. So my presentation is about the same stuff what my colleagues previously have spoken about. It's about consistency, predictability, and actually the credibility to the policy itself. So the Central Bank of Ukraine, as other emerging market central banks with very, let's say, little experience in inflation targeting, they have no privilege to hesitate in monetary policy reaction. So the NBU was among the first central bank to hike the key policy rates. We actually were among the central banks in the group of central banks who are relatively young inflation targeters, and they started to hike rates among first. At that time, when we started the hiking cycle, like central banks of advanced economies, they were explained that the inflationary shock is transitory in its nature, so it will inflation will be self-resuming problem. But we didn't have such a luxury because high inflation started to affect inflation expectations as they backward-looking. So people are just seeing that the goods and services they are buying are becoming more expensive, and they're expecting this process to continue. But nevertheless, our prompt reaction gives us the ability to control inflation expectations. Of course, they are high, but in the case, in the scenario when Central Bank of Ukraine didn't react to the inflationary pressure, we would have really negative consequences in terms of an anchoring inflation expectations. So that was vital at that time. And I wanted to share results of work from my colleagues. They just tried to model credibility, and this term of credibility is they included in our quarterly projection model. And as you can see, it's very vital for central bank to preserve credibility, as otherwise this inflation process become costlier. And that's actually the main result of this research. So in case of low credibility, you need to increase key rate more, and actually outcomes in terms of inflation is less effective. So you have higher inflation. At the same time, the output gap becomes more negative. So in terms of like losing credibility is very costly for the central bank. Nevertheless, that we are relatively young inflation targeting central bank. We have some results in terms of credibility to national currency. I mean, we have strong growth for the strong trend for disinflation, and these achievements need to be preserved. And for this, of course, to adhere to its strategy in monetary policy reaction is very crucial. It revealed that not considering inflation as a self-resuming problem, it is a right strategy, because currently inflation is scaring for market participants, and for policy makers it's headache, and there is a lot of discomfort in societies as incomes and savings are just vanishing because of high inflation, and more central banks are going to a tightening cycle, and the overall mood among the central bank is becoming more hawkish. For us, I think it's very crucial to move in the right direction. I mean, to tighten the policy, but to avoid shocks to the market with own action. So we're trying to be proactive and forward-looking, but to be predictable as much as possible. So we started to give forward guidance, hawkish one, already in January, and then in line with this forward guidance, the National Bank hike policy rate for the first time on the second MPC in March, and then we continue to move according to the forward guidance. If there were deviation, we publish in our forecast of key policy rate, as well as Central Bank of Georgia. But we can deviate from it if there is deviation risks, inflationary risk as well. So we're doing that. We are moving in line with forward guidance, trying to be predictable to the market. Same is
Volodymyr.
Yes.
Sorry for interruption. Could you start your presentation? It doesn't work, at least for me.
Oh, it's not moving.
Yes.
Okay. Now it's okay.
Can you make it bigger? It's.
You can see the presentation, but oh.
Now it's.
We see the presentation, but can you put this kind of as a kind of the bigger full screen for the slides?
Yeah, I see, but I already done it, but it's not working. Let's try this way.
Perfect. Now it's perfect.
Okay, thank you. So in line with monetary policy tightening, the National Bank phased out from non-conventional measures that were taken in the midst of crisis in 2020. It's long-term refinancing and interest rate swaps. But again, the National Bank tried to avoid shocks to the market, and this was a gradual phase out. It was announced in advance and done in like a gradual manner. We just limited the and decreased the amount of these operations to zero. So on inflation, according to our forecast, we expect that the National Bank will hit its target of 5% at the end of the next year. We already passed the peak of inflation. It started to decrease, but very slowly. And risks are definitely tilted to the upside, as we can see from historical evidence. So overall, components of our CPI are frequently moving in divergent directions. And actually, it's when you're trying to forecast inflation in Ukraine, you could be successful if one surprises pro-inflationary one will be offset by deflationary surprises from other components. So at the end, you will get the number close to your forecast, but you have mistakes in the components. Anyway, there are historical evidence that actually risks are tilted to upside, because, for example, prices for services are main, let's say, persistent driver of inflation because of structural imbalances on the labor market, as there is supply of, let's say, white collars professions, and there are more demand for blue collars. So there is a mismatch, and that labor market is very tight because of that. And actually, labor migration is adding to this. since we get visa-free agreement with European Union, labor migration intensified a lot, and currently, after very short pause, it started to intensify again after our countries which are main recipients of migrants are hunger for our labor force. So that will be the driver for inflation in the near future, and risks are tilted to the upside. Ukraine has, I think, the largest share of food components in its CPI basket, and that's why we very dependent on the global price developments and on harvest. So this year harvest is record high, but it's, let's say, exemption from regional perspective, because we are the only country, I think, in the region with such a record high harvest. Our hope was that actually this high supply will allow to change the trend of food inflation, but currently food prices are higher on international markets than we assumed before. So the risks definitely are on this component as well. For administrative inflation, actually, in the short term, it helps to limit inflationary pressure, as there are decision to fix the natural gas tariffs for population, and there is kind of administrative control for fuels. So in the short term, it's good, but it leads to accumulation of imbalances on other sectors, and there are risks of possible tariff adjustments in the future. So the main disinflationary factor in Ukraine currently is appreciation of national currency, and that's a factor which allowed to stabilize fundamental inflationary pressure. There is a reason behind such appreciation, and fundamental one, and that's mainly benign situation on markets for our export and record high harvest. So, that's the main reason why we have such an appreciation. And sticking to flexible exchange rate is very vital in our case, because that's the factor that allows us to disinflate. We're using our fund charts for forecast of key policy rate and inflation, as well as a communication tool. You can see here that the risks are tilted to upside. So, and in the case of realization of such risks, National Bank gave forward guidance that it will react with its policy instruments to achieve inflation target of 5%. So my message here is that central bank in its policy, in its monetary policy, especially, it's relevant for young inflation targeters. It needs to be proactive, but remain as predictable as possible to create this, let's say, some certainty with its actions in this world full of uncertainties. Thank you.
Thank you, Volodymyr. Any questions from them? Audience, I'm seeing
My presentation will not be as technical as the speeches of my colleagues, but I will try to I'll try to give you a summary of the market's perspectives on the developments, and I will speak also broadly about the CEMEA region. So I'm head of CEMEA economics, and I focus primarily on Ukraine, Russia, and recently more on Turkey. But I will be comparing also the monetary policy response in South Africa, in CE, to the recent inflation shock. Just before I start, I'm checking whether you hear me well. It seems it's all good. Okay, I will not be using presentations. Hopefully it will then also help us to avoid some technical issues. So where do we start? I must say, first of all, the markets do acknowledge that the central bank's job this year was non-trivial, right? So in the midst of very supportive pro-growth policy mix, as the global economy started to recover from the pandemic, we see inflation pressures starting to emerge. And here is the question which every central bank has, and which the markets seeing what the central banks will do. What do you prioritize? Growth remains still fragile. And here you see inflation pressures increasingly building up. And some central banks have growth as part of their mandate, and some only focus exclusively on inflation. And when we speak with investors, then you always tend to start ranking on credibility. So early response to pressures was very welcome in Ukraine. Actually, Turkey as well. They hiked the policy rate as early as March. Unfortunately, then the governor was dismissed. So this hike was welcome, but again, the changes in the leadership resulted in the adverse market reaction. Russia hiked rates early. In CE, we saw rate hikes later in June in Czech and Hungary, and in October in Poland. But there again, inflation pressures took longer to build up. So there, the speed of the monetary policy response was key for the markets. And overall, in CE, we had three distinctive responses, as I mentioned just now. One is very proactive, very front-loaded policy response. That's Ukraine, CE3, Russia, and paradoxically, the earlier you hike, the earlier you can start easing, or the higher you bring rates, right? The earlier you have a possibility to break the trend and then relieve the pressure. And then we have South Africa Central Bank. There, they were more fortunate, more lucky with anchored inflation expectations. So their inflation expectations didn't deteriorate as much, and also FX pass-through was much lower. Hence, we only see tightening happening gradually in the forecast horizon, and only in 25 basis points increments. So it's quite a different story. And in contrast, as my colleague Mr. Kara was describing, and I wished he spent more time on recent developments. It's a really big focus of the markets, but again, not the exact subject of the conference. So the Central Bank of Turkey, we see them laser focused on growth. There is a preference for lower rates, and there is a tolerance for a weaker currency. So hence, contrary to the rest of the EM central banks that in the focus, we see easing cycle ongoing. And inflation outlook quite uncertain. I thought it was I'll try not to repeat my colleagues, but I thought it's worth flagging that we were all wrong on inflation, and by we I mean inflation forecasters, I mean the market, I mean unfortunately the central banks as well, as the developments were unseen in the past, and even now we cannot say where is the peak. So the overall inflation materialized above expectations, and when we look on the forecast horizon, risks are tilted to the upside across the board. So yes, it started earlier this year with a V-shaped recovery, strong rebound of demand. It was so consumption of households in our region was all mostly goods oriented, less services. They were spending more time, more funds on goods, and supply chains were too slow to respond. Plus we add to that tight labor markets. That was the part of supply chain disruptions, again, labor shortages, wage pressures. My colleagues touched on high commodity prices. There is food, energy, so gas prices in Europe are at record highs. It matters also for CE and Ukraine, and it has a spillover effect, right? So gas prices are input for production of other goods. And when these pressures all were coming, fiscal stance was and is stimulating still accommodative in many economies. On the FX pass-through, again, Turkey example stands out. On the contrast, Ukraine was lucky because hryvnia outperformed other EM currencies. So in that sense, there was some support for the National Bank of Ukraine. And the debate, which is still ongoing this year, is yes, we have really strong inflation pressures, and to them depends on whether you consider them transitory or lasting. And here I think the opinions diverge, but because of course this is supply side shock, and surge in global commodity prices again is part of supply side story. But to us, by us here, I mean global economics research at Morgan Stanley and my colleagues from global economics team. Now the shock seems less transient than previously thought. And the reasons for that, one is there is strong domestic demand, which gives much more pricing power to producers and retailers. And any supply disruption, it translates immediately into prices with no loss of production, with no drop of demand. And second is high inflation expectations. High and rising inflation expectations mean that the behavior of all economic agents change. So the whole system starts to operate as if inflation is and will remain higher, and this factor affects monetary conditions. Here, I want also to pull in the topic of food inflation, as in all our region, food inflation is running the highest, say, compared to non-food and inflation. And when say investors ask, do the central banks really need to respond to food inflation given that they don't have direct control on it? And the answer is probably they should, because food impacts inflation expectations most directly. And high inflation expectations mean that when households look at lending and deposit rates become in real terms, adjusted for inflation expectations, less attractive, and lending rates become more attractive, and the behavior of households becomes less savings oriented, again more consumption oriented. And we can see the cases of surge in front-loaded consumption, in case of Turkey, if people expect prices to go higher. Hence, it becomes a circle where the central bank chases inflation, but then inflation puts inflation expectations higher, and you need to hike rates further. Finally, what's important is, unfortunately, just bringing this discussion to what happens at the moment, right now, as we speak. The battle is not over yet, and we have still challenges ahead. And first and foremost, unfortunately, the the pandemic story is not over yet. It's particularly true in Ukraine. We have number of cases, of new cases, and number of deaths above the historic peaks. We see the wave spreading in Europe, in C3 as well. The new wave just started to emerge in South Africa, and this time around, policymakers are more careful to introduce strict lockdowns, but still we expect more restrictions, which in the medium term will be pro-inflationary. So we see COVID-related restrictions cooling demand and disinflationary in the short term, but medium term, again, it brings back the problem of supply chains, etc. And just today, I added some lines for my speech, given that now there are news of the new strain found, and it seems so far is very local, but that increases risks. So we are facing still fatter tails in our projections and forecasts. I thought, for the sake of spending more time on questions, I hope there will be more of them. We have an interesting panel. I will stop here, but before I finish completely, I just wanted to repeat that in these times of stress, what the experience of this year teaches us is this is the time when you see all the central bank's efforts to build credibility, to build independence, paying off, and these two features, credibility and independence, cannot be overestimated. So let me stop here.
Thank you, Alina, for giving a different perspective from the private sector. Any questions? If I have one on my side, I think you mentioned we were all wrong, kind of about this expectation. I'll provoke you. I want to provoke you asking in which part we were kind of wrong, and I'll give you kind of a hint, a little bit, not a hint, but a question. The following: in the past, when we had kind of a very large monetary stimulus in advanced countries, we didn't see kind of a lot of inflation exported to other countries because we had a kind of a China which was exporting deflation, right? Like, in a sense, do you see part of the story is that kind of China is not exporting that deflation, which kind of offsets a little bit, and then kind of countries facing a challenge? Because in the past, I mean, Ukraine, Georgia, you did inflation targeting to offset fiscal policy, domestic fiscal policy, and that was quite successful. So without the kind of China's or other kind of large deflationary pressures, is this what we're missing or something else? Thank you.
Yes, thanks, Carlos. I think China is part of the story. Just seeing how the recovery materialized. One debate that we had, to what extent, how quick will be the recovery? So the recovery was much stronger, and we forecasted the V-shaped recovery, but it was even quicker than we thought. Many economies in the region they reached pre-COVID levels faster than expected. So surge in demand was much faster. And yes, we knew that supply response will be lagging, but I think the gap was high. And again, energy prices still were higher than our forecast at the beginning of the year. And finally, what was particular this year, we didn't, so tightening from the EM central banks was not accompanied by strengthening currencies. So EMFX was still weaker, was again not supported by the tightening by the central banks.
Thank you, Elena. I missed one question which was kind of posted to Vladimir, and it was kind of in a chat box. And the question is where you kind of you had a mention about communication and forward guidance. How do you draw a line between kind of communication and kind of forward guidance? Because in a sense, Ukraine faces a lot of shocks, and since obviously there might be kind of a lot of departures from that kind of a forward guidance. So how do you do that balancing act?
Actually, our forward guidance is different from what Fed is doing. For example, it's a conditional one. So at the end of every press release on decision on key policy rate, we have a special place for forward guidance. For example, in the recent one, we indicated that, for example, if said or any other pre-inflationary risk materialize, NBU stands ready to raise its key policy rate and deploy other monetary policy tools. It could decide to do so even during the December meeting. So it's like we are mentioning risks which are seen on the forecast horizon, and then we are trying to explain how we plan to react to these risks. It could be like two-sided forward guidance, like we are seeing like reasons to decrease the key policy rate, or we are seeing reasons to increase it, or it could be purely hawkish or purely dovish. So currently we are in pure hawkish mode.
Thank you. One kind of a question also to Alina, because in a sense you kind of present the private sector, and one of these kind of surprises what we kind of see is, because obviously elevated inflation has a lot of social impact in a sense. And how do you see, I mean people have been quite tolerant. You have an increase in food prices, in energy prices, I mean, which is kind of socially sensitive. Do you see any risks? Because in a sense, if the central bank is not able to, if it's a longer term, it's not only that the tools you're out of tools, but also how do you manage these kind of social pressures? Do you see how this is going to develop in the medium to longer term if inflation is kind of more permanent?
Yes, thanks, Carlos. Indeed, you are right. Globally, food prices are higher. And first and foremost, it matters for EM. Because of course income levels are lower, food is larger share of the CPI basket, and in most cases in our countries, EM countries had less fiscal space to support the economies. So they have less fiscal space, and they have higher inflation because of food, the lower the income level is, the more challenges the country faces. This can lead to social unrests, to instability in the society. And then what happens? Policymakers, so first like politicians, but then like policymakers are under pressure to respond. And again, this brings, you know, this brings an uncomfortable question between macro stability and social stability, how they, you know, how you find the balance in the short and in the long term, because you might this brings the independence of the central bank into a even more important you know, place, because short-term incentives to support population means that you will face inflation pressures for longer and eventually will need to tighten. So as Mr. Kara mentioned, you might be borrowing from your future growth. So you like being generous in the moment is you know, can have adverse impacts long term. And I think in these scenarios also the policymakers really have to collaborate, because then it's about fine-tuning fiscal and monetary policy response to the challenges. They cannot go in both in you know, in the different directions at the same time. I see the case where, like, if there is a very targeted fiscal response to higher food pressures, and support to lower income population, you would not, you know, the pressure on the central banks to lower rates, for example, for the sake of growth, will also be lower.
Yeah. Thank you, Alina, and thank you all panelists. This was fascinating kind of session. This concludes this interesting session. There's a question, one in the chat room. I think, Alina, if you have a moment, you might do it. But I think, Sergey, we are handing over to the next session. Thank you all.
Yes, indeed, and thank you very much, Carlis, and all participants for fascinating session. And we have to move to the third one, and this third session is devoted to it's more research oriented, I should say, and I suppose it will provide us some insights about the inflation target in future and how this monetary policy regime may evolve. And it's my great pleasure to pass the floor to Tomáš Holub, who is the member of the board of the Czech National Bank. And Tomáš spent already more than 20 years in the Czech National Bank, which is considered as one of the, I would say, the best inflation targeting performing central bank in the world. So, Tomáš, please, the floor is yours.
Thank you, Sergey, very much. I'm really delighted that I was invited by the National Bank of Ukraine to chair this last session in this great conference. From the previous session, it was very clear that currently the policy frameworks of central banks are under pressure, because we are trying to achieve price stability in an environment which is characterized by stagflationary shocks or supply side shocks. And in some countries, these are hitting economies that have shown signs of overheating and tendency of inflation expectations to move up. Of course, this is nothing fundamentally new in the economic history. We've seen it before, and hopefully our policy frameworks can cope with it. After all, inflation targeting framework has been devised in a kind of flexible manner as a kind of constrained discretion approach that can on the one hand, anchor inflation expectations in the long term, and on the other hand, allows us some flexibility to respond to unforeseen shocks, including stagflationary supply side shocks. But nevertheless, it's of course very important to discuss how the framework has performed in the past and what are the lessons for the future. And I'm glad that in this session 3, we will have 4 contributions to that debate from 3 different countries. 2 presenters will represent the National Bank of Ukraine. There is also 1 speaker from the Central Reserve Bank of Peru and 1 speaker from National Bank of Romania. So quite geographically diverse panel. I'm glad about this. So let me start. We are, of course, under time pressure, so I will not spend too much time on my introduction. So let me pass the floor to the first speaker, who is Alexander Farina from the National Bank of Ukraine, who will speak on central bank performance under inflation targeting, the role of policy design and institutional quality. So a very important topic. So please, Alexander, the floor is yours. As in the previous sessions, you will have roughly 15 minutes for the presentation, and then we can follow up with the discussion. So please go ahead. Okay, Alexander, can you hear me? Are you with us? Hello, are you there?
Please wait a minute.
Okay,
He's joining us.
Okay, perfect. So
just a minute.
Wait for a while. Okay.
Probably it's better to go to another participant and let Alexander to step up later.
Okay, so thank you very much. So the second presenter is our colleague Adrián Armas Rivas from the Central Reserve Bank of Peru, who is going to speak about inflation targeting in a partially dollarized economy, the case of Peru. So please, Adrián, if you are ready, you can start.
Thank you, Thomas. Thank you, the Central Bank of Ukraine. First of all, good morning since here. I guess it's good afternoon over there in East Europe. So let me first thank you for the opportunity to share the Peruvian experience, and let me share my screen. Do you see my screen, just to be sure?
Yes, we do.
Okay, great. So I understand I have 15 minutes, so I will go probably to the main slides. I will talk about 2 main topics. One is monetary policy specifically, and the second one is the characteristic of many emerging countries that the recession risk that we have in our financial system. As is very well known, the IT inflation targeting regime framework became quite popular in emerging markets at the end of the last century. Peru is, according to our record, is the first country to adopt the IT regime, being a highly financial dollarized economy. At the time, we have, as many of our countries with high level of dollarization, we have the option to have a passive one, just to peg the exchange rate. Second, to get an active monetary policy following the book, the orthodox methods, free floating, etc., which we think is not also appropriated, neither the first one, neither the second one. But then
sorry
the
for
third
interruption again. Andre, please pay attention that your presentation is not moving. Just switch to the slideshow regime or so.
Okay.
Because
so you don't see.
We can see only one slide.
Oh, okay. Maybe I will try with you. Yeah, I will try. Thank you for. Yeah. Okay, let's see.
Okay, it works
Thank
now.
you.
Thank you.
Okay, so now, so what we took is a monetary, we chose the inflation target regime because we thought that it was the best regime in order to get confidence again in the domestic currency. It allows to try to have an independent monetary policy, in particular to facing negative shocks to the economy. Of course, the idea that with low inflation, the currency will fulfill accordingly all the important function of the money. So what we have here is this part. The first part is the traditional inflation target regime, plus some different tools that we call it measure to control dollarization risk, such as high reserve requirement on forex liability, forex intervention to reduce exchange rate volatility, precautionary accumulation of international reserve in good periods, meaning in period of booming or capital inflows. So talking about the first one, preconditions, of course, there are always preconditions, but what we found in Peru and in many Latin American countries, probably is the case in other regions as well, is that once you are entering into the IT regime, there is an endogenous movement within the central bank in order to achieve this ideal precondition. So it's a process of learning by doing. For instance, at the time we have to adopt our macroeconomic forecasting models to incorporate the fact that we have the monetary system. So we include, for instance, real estate rate in US dollars in the aggregate demand equation. We have to include potential balance sheet effect. We have to include also reserve requirements. We have to include on the exchange rate equation the fact that we intervene to reduce exchange rate volatility. Some characteristics, of course, that the Phillips curves, given the credibility that we got, there is a relative low exchange rate pass-through between 0.1 to 0.15 in the first year. So the inflation target range, maybe that's, we have the lowest inflation target among emerging economies. Our target is between 1 to 3%. The philosophy here is that in Peru, by constitution, people is free to keep dollar or domestic currency. So that in order to be able to compete in the long run with the dollar, we try to keep the inflation as low as possible to the US inflation rate. The other thing that in respect, sorry. Now, just to give you an idea, in these 20 years, almost 2 years with IT regime in Peru, we have the lowest inflation rate, average inflation rate in the region, or comparing only with Panama, for instance, Panama does not have their own currency, they have their full dollarization. So we have this quite low inflation rate. And also you can see that we have one of the lowest volatility of inflation in the region as well, which is consistent with the IT regime. Economic growth was high in Peru in this century in a context of price stability environment. I will go a little bit faster. Now, one key element was the operative target, the going to a policy rate. That was not an easy step. It takes some time to adequate monetary policy procedures to get the policy rate. Once we did it, since 2003, we have this difference. Before probably you have maybe the same experience in Ukraine, but before that, we have a quite volatility of the money market. In this environment was quite difficult to develop financial market in domestic currency. After that, the policy rate was a guide for the formation of interrate for different timing. During all this period, given the low inflation, that is the level of our policy rate, has been countercyclical. I can say that it has served well to the economy adopting this regime. New challenge probably was this pandemic situation, when given the magnitude of the shock, by the very first time, we reached the zero lower bound. So probably we are one of the few emerging market economies that have reached the lower bounds, the zero lower bound. But now with inflation everywhere, as we know, we are removing the monetary stimulus. Now our policy rate is 2% as today. Communication has been key. We have this measure of communication tone. When it's higher, it means that we are more hawkish message. Lower means more dovish, and over time, the markets have learned how to read better monetary policy message, which is, we know, quite important to the entire red channel. Here, I want to show you how countercyclical has been the monetary policy rate in Peru. And also, we have to deal with new non-conventional tools, such as provide massive liquidity during the pandemic crisis. So the way that we did it was through repo with credits, with the government, with full government guarantee. So that's the way we provide liquidity during the pandemic crisis. As a consequence, last year, Peru had a very high rate of credit to firms, so we have a real countercyclical monetary policy, also in terms of the credit cycle, something that is typically difficult. That's because the action that I already described. The second part is the development of financial markets. That is before the IT or yield curve, high interest rate with low confidence, of course at the time also high public debt. Now what you can see now is quite low yields. For instance, currently we are in the region is in the middle of a crisis, of course, with a lot of political uncertainty. A 10-year yield bond is now 5.9% nominal terms. But for instance, in December, it was 3.5%. So there is, we have reached low levels for a long term, which means there is a low inflation expectation, low-run inflation expectation already achieved in Peru. Well, this graph is only show you how important has been the development of the local debt. That's quite clear. You can see that as long as the government start to issuing bonds in domestic currency, the private sector followed almost immediately. As a consequence, you can see here, for instance, 20 years ago, all the bonds were in solid nominal was 5%. Now it's 76%. Before in dollars was almost 80%. Now it's 18%. Monetary policy transmission mechanism, just to give you the main idea here. In 10 years, real dollarization, meaning exchange rate pass-through to CPI, has been reduced, as I mentioned before. Payment dollarization has been modestly reduced, but what is quite relevant to share the experience, financial dollarization, meaning deposits and credits, there was a clear reduction, as you can see. So talking about dollarization risk and how we deal with that, we are in a region also with a tendency of dollarization. We are close to United States. A lot of links with this big country. The red chart, you can see the dollarization in the region. We are part of that, of course. Talking here about broad money, we start 20 years ago with this level, and that's the process with IT. And what we did is what we call it, we breaking the Gresham law. Just to remind everybody, maybe the Gresham law is established this idea with the bimetallic system that when you have two currency or two metals, the one that is used for transactions is the bad currency, and the one which is used for as a store of value is the good currency. So we have in the past this division between silver and gold, and now typically many countries domestic currency and dollars. So when I said that we break integration law, what I meant is that during the IT period, Peruvian citizens start to think about domestic currency not only for transaction but also as a store of value. So just give you some ideas. These deposits is a long-run deposit in Peru. Before it was 90% in dollars. Now it's 21% in dollars. So that's to, and in terms of credit, for instance, mortgage credit, for instance, it was 94% in dollars 20 years ago. Now it's just 12% in dollars. The rest is in domestic currency in nominal terms. We use reserve requirements, a higher reserve requirement, because we have liquidity risk. Of course, the Central Bank of Peru is not a lender of last resort in foreign currency. The Fed is, we don't. So we have, for that reason, a higher reserve requirement on FX liabilities. We intervene with a philosophy of leaning against the wind, trying to reduce exchange rate volatility. That's what you can see here. As a consequence, when you, for instance, take a look to the exchange rate in Latin American countries, the Peruvian sol, which is the Peruvian currency, follow the trend of all peers' currency, but with lower volatility, which is consistent with what I said. It's symmetric in the sense that we don't try to, of course, to determine a specific value, but just trying to reduce the exchange rate volatility. We have a strong position of international reserves to face external shock. We are a commodity exporter, so also vulnerable to both in terms of trade shocks and capital outflows shocks. So just to try to summarize, our policy response to encourage de-dollarization in the economy has been keeping low inflation rates. Policy rates as a monetary instrument, it helps to develop a financial market in domestic currency, as well as the benchmark provided by the sovereign bonds in domestic currency, and also pricing in soles, which meaning that we have some measures. For instance, in 2004, before there was a law, a consumer law, that established that the seller has to put prices in domestic currency. We do not forbid to put prices in dollars. If they want, they can do it. But what they cannot do is to discriminate against domestic currency. And that was something important for us because in the past, we used to think for many items in terms of dollar. For instance, kitchens, refrigerators, television. Myself, 20 years ago, I have to think if one TV was $150, let's say. Now I am thinking is 600 soles. So that's the way of they change the way that you are thinking, because in that regard, you start to also to save more in your own domestic currency. At the end of the day, the currency is a matter of custom, of credibility. So the recession here for the credit, as you can see, has been a strong reduction in credit dollarization. There are differences. For instance, corporate sectors has a higher degree of dollarization as opposed to small and micro businesses, which is very low dollarization, 4%. Household also, the dollarization for credit for household is quite low. Still, there are some stickiness or hysteresis in some sector of the economy. For instance, input cost. The prices that in the Peruvian economy, the input prices are high. So final goods and services are almost in domestic currency, but the input market the dollarization is high, as you can see here. So just to finish the main idea that I want to express in this conference about the Peruvian experience is that keeping low inflation pay off to the economy. There has been a process of voluntary dollarization of the population. We have been able to build a monetary policy which is countercyclical. But of course, we have to be realistic about the reality, so we have to include other instruments that are not conventional ones, such as trying to have a high level of international reserve, trying to reduce exchange rate volatility, impose higher reserve requirement on FX liability. And that's mainly what I want to share with you. And thank you again for the opportunity, Thomas.
Thank you very much, Adrian, for an excellent presentation. It's clear that dollarization is a kind of obstacle, or at least a challenge for successful inflation targeting. Many people have argued that dollarization or euroization is endogenous. So if you do good policies, it will decline over time. But to the best of my knowledge, there are not so many successful examples of such a de-dollarization really taking place. So I'm glad to see from your presentation that Peru is one of such cases where the progress is really visible and impressive. So congratulations on that. And I think it's time to go to question. I have here one from Hakan Kara. So the question is, how did you manage the capital flows during this process? If you had any hard or soft capital controls in Peru?
Yeah, thank you. That's an excellent question. That's something that I forgot to mention. There is no capital controls. In general, in Peru, we did a deep reforms because we passed from being an economy with a lot of hyperinflation, capital controls, price controls, all the distortion that we know is not good for the economy. So far at least, there is no capital controls. But what we have, as I already mentioned, is a reserve requirement on FX liability for the financial system, because what we, in our reading, the capital inflows could have an impact of the credit cycle in our own economy. So we have to be careful about that. There are liquidity risks coming from financial dollarization. So there is a reserve requirement. In general terms, are very similar reserve requirements on deposit for resident and for foreigners. So there is not much difference, but in fact, what we saw in the data is that short-term short-term debt for banks is more volatile than deposit, for instance, in a long horizon, you know, when you took a long horizon data. But there is no philosophy to impose capital controls on firm on house. So that's something that we have not do it because there are distortions there. The other tools has been good enough to avoid to use other measures.
Okay, thank you very much, Adrian. And there is one more question from Rastem Orazalin. It's about FX interventions. As he correctly states, FX interventions are a difficult part of inflation targeting, as was mentioned at the beginning of today's workshop. But you manage it very well in Peru. So what's specific about your country's experience?
Peru was the first country in Latin America to abandon the peg exchange rate in 1990. But there was also this intervention, this administrative floating intervention. The way that we do it is in a discretionary way. So we have almost 31 years with intervention in this matter. What the market players see about Peru is the data that I already showed you, that for a long time, the exchange rate is less volatile. So in some sense, the formation of exchange rate expectation about the future has been already affected because what the markets know is that we are going to intervene. That's one aspect. The second aspect is that even though Peru is an economy with free capital flows, we have financial integration certainly with the rest of the world. We have here, for instance, half of the holders of the sovereign bonds are non-resident investors. There is a forward market developed onshore and offshore, even though when we look at the size of the Forex market, for instance, this data that the BIS publish each 3 years, and we compare the relative size of the Forex market against other countries, we still have a relatively small market. So in my view, probably that's also an explanation. In practice, because there is no perfect financial integration, let's say that probably that intervention has an impact. And also, it is true that the way that we intervene on a daily basis is using what we call intelligent financial information. There are, for instance, if there is one day when there is a shock, like for instance last year, March 15, when everybody realized that we have a pandemic in the world, and there was a exchange rate appreciation across the world, you know that you can do much about it. I mean, you have just to allow the price to adjust, and maybe when there is an important adjustment, then and only then trying to intervene to moderate. So I guess that as long as you're trying to moderate, you can have some success. And also that's something that, if I remember correctly, there is some work made by BIS that in general show that when you try to moderate, maybe depending of course of each situation, maybe you can effectively moderate, but depends on of course on the circumstances of each country.
So thank you very much, Jan. I have one last question, so I suggest if you can answer it briefly, and then we will go to the next speaker. It's again from Hakan Kara. He asked whether the low FX volatility did cause a kind of moral hazard problem or encouraged excessive FX risk-taking, such as leading to more open, unhedged foreign exchange positions for corporates?
Yeah, that's an excellent question. That's something that's typical. It's hard to say. Just to let me elaborate a little bit. For some reasons, probably because the corporate sector has the chance to ask for a lending in dollars, or they have the opportunity to have deposit. The forward market, they are not much participation of the real sector in the forward markets. That is a fact. It's something that we tried hard, but to be honest, we have not been success to do that. The firms during for instance, when there was a taper tantrum in 2013, there was a exchange rate precision in all emerging economies between 2013 and 2015. The firms were affected. There were some exchange rate losses because of that. There was a depreciation about 35% in 2 years. But the question for us is, okay, how much you could allow a depreciation in order that the private sector learn from that? We are not, I understand that we understand the idea, but empirically, we have not seen a change of behavior. And also, we have the question to ourselves that the argument of moral hazard is credible if you can allow, if you know that this more volatility do not have any impact on the economy. But if there is a balance sheet effect, then you have to intervene. So we here sort of something that we have to some problem of consistency. If we claim that we are not going to intervene, and then we have to do it. But I agree that as long as dollarization is lower, in our view, you can allow a greater exchange rate flexibility. In theory, in the limit, if you don't have dollarization problem, then you could maybe allow a free float. And thank you for the question.
Okay, thank you, Adrian. So let us go to the second speaker. I can see that Alexander Farina is already with us. Please, Alexander, the floor is yours.
Thank you very much, Mr. Volov. My apologies for technical problems. My computer just simply decided to take a nap and it was not responding at all. So now I will try to share my screen one more time. Do you see my slides?
Yes, yes, I can see.
Great. So if I may start. So today I'm going to talk about the experience of also inflation targeting central banks around the globe, with a particular emphasis on the role of the policy design and institutional quality. So this is kind of a part of a joint project with Sergei Nikolachuk and Viktor Kozyuk. And the usual disclaimer applies here, since this is only my views, they do not necessarily correspond to Sergei's or Viktor's views. And of course, they should not be treated as official position of the National Bank of Ukraine. So to start with, let me remind you what the governor Shevchenko told today during his opening speech. He said that inflation targeting is not about celebrating when inflation hits the target precisely, right? And indeed, most time what we do in the central banks, we try to understand why inflation is not on the target and what can shake it in the future and what can we do it actually to reduce this volatility and to keep inflation at least within the target band, okay? And this is exactly what my project is about. I will try to look at the experience of all on how central banks around the globe were performing in terms of holding their promises to keep inflation on target. So to start with, let me first emphasize how quickly inflation targeting becomes popular around the world and how quickly it sweeps through the world. So now we have 41 inflation targeting countries and 30 30 of them are emerging markets, right? And we already have on average 17 years of experience of inflation targeting, so we have something to learn from, right? So we can look how different economies performed, and we can draw some lessons for future for our policy frameworks. So inflation targeting has a single and very simple idea. So to steer inflation, or more maybe inflation expectations, around its publicly declared target. And there is a clear evidence in the literature that it has a lot of benefits we have lots of benefits from inflation targeting. Generally, I call it macroeconomic stability, but we can say that inflation volatility reduced, economic development became more stable, economies in general became more resilient to negative shocks, right? At the same time, we can see that the framework is very flexible. We can find different countries in advanced world and in emerging world with different design, different target levels, target ranges, even inflation measures for the target, right? At the same time, it is possible to implement inflation targeting under different quality of institutions. Some countries are very developed in terms of institutional quality, some are still catching up, but inflation targeting works there as well. So we need to see whether actually all our efforts for increasing and improving institutional quality, they actually give some benefits. So having this in mind, when we think about the differences across countries, we usually, in inflation targeting, we usually think about the target level and the design of inflation targeting. So here on this figure, you can see how average inflation target, so I have it, the 5-year average inflation target, relates to experience of inflation targeting framework, right? So here you have years since inflation targeting started. And we can observe that generally newcomers, countries that just launch inflation targeting, they have higher targets. And usually it's simply explained by the need for disinflation, especially in emerging economies when countries actually start the inflation targeting policy when inflation is too high and they want to reduce it for the future. What else we can see is that in advanced economies, the target was initially very low and stable. So it was around 2%. So the median target is 2% for advanced economies. But for emerging economies in a more stable period, we have a mixed picture. So some countries have very high targets. For example, Ghana has 8% target, and it's already a couple of a decade or so. Some countries have very low inflation target. And we just heard Dr. Armas, who told a lot about Peruvian experience and a pretty good performance for such a low inflation target in emerging economy. So now the question is like, why emerging markets, does it actually matter for emerging world to have this different policy design? So this is what we are going to think of. So while having different targets, central banks did a lot to be able to keep their promises and to keep inflation on target. So here you have on this figure you can see the transparency index. So this index. It was developed by Green. It's the data set. It covers a lot of countries, but basically it includes political, economical, procedural, policy, and operational transparency. And we see that there was a huge jump just right in the beginning of inflation targeting. And moreover, it's still improving. So many economies, even after 10, 15, 20 years after the implementation of inflation targeting, they still improve their transparency because they believe that they need this transparency to improve their credibility, okay? But what we also see here is that emerging economies here, they are slower, so they're still catching up. And advanced economies are much better in terms of transparency. So we need to think about our future and improve transparency to reach and catch up with the advanced world. At the same time, another aspect of institutional quality is central bank independence. And there good index for that. The index developed by Baudet and Hicks, also for a variety of countries. It includes a legal independence. So they review the legislation for different countries, and they come up with an index which reflects the legal independence, whether the governor, how governor is independent, whether central bank independently formulated policy, its objective and mandate and stuff like that, right? And this index is improving with time. But when we look at the picture for inflation targeting economies, it seems that actually emerging countries, they were better at the beginning of inflation targeting start, right? So much better than advanced economies. So it seems that the legal independence or de jure independence should not always be treated as de facto independence. If we take this index and calculate the correlations with some other indicators, we can actually observe the negative correlation with, for example, other governance indicators like political stability and government effectiveness. So it seems that central bank independence, legal independence, is not enough for inflation targeting central banks. Central banks perform. So, on this picture, you can see the performance in terms of the average deviations of inflation from the target, which is compared to the experience of inflation targeting countries. So here we see that with time, after consistent policy, deviations of inflation from the target reduces a lot. So in the beginning, of course, there is some huge deviations, and both for developed economies and for less developed economies. But if you look at longer ranges, it becomes clear that our experience helps us to get better performance in terms of reaching targets. Another view how central banks perform is plotted on this picture, which shows how average deviation from the target is related to different target levels. So here we see that for countries with very high inflation target, we can observe much higher volatility, and moreover, this volatility is upward. So higher inflation induce upward deviations from the target and from the target range as well. But for countries with very low inflation target, we don't see that much of difference. So this makes kind of indicates that if we tolerate higher inflation targets, then we will not necessarily keep inflation on this target. It will usually deviate more above its target than below its target. Yeah. Another measure of how can we measure the performance is frequency and duration of inflation expectations. So here in this figure, it also relates to the level of the target for different economies, and we see that the frequency and duration is asymmetric. Countries with higher inflation targets, they tend to overshoot inflation target more oftenly, and the inflation stays continuously stays above the target longer. But if it comes to countries with lower inflation target, the picture is vice versa, right? So that countries with low inflation targets, they more oftenly undershoot inflation target, and they stay in this period much more longer. So it seems that the truth is somewhere in the beginning, at least maybe for emerging economies. So let's put everything together, put all these thoughts into kind of one analysis. So we estimate a variety of models using different approaches for all these 41 inflation targeting economies using their annual data. And we distinguish between different deviations in order to understand whether our design and whether our institutional quality, what effects they have on the performance. So here what we have is that for policy design, the higher is the inflation target, as we already discussed, the higher is deviations above the target. right? And even more so, the higher deviation above the target range. What is interesting is that if we accept a wider inflation target range in order to be kind of to gain credibility, so this is associated even with higher deviations, and it does not necessarily guarantee that inflation will stay within this band. In terms of institutional quality, we can easily see that experience, regulatory quality, and political stability, this is what important for countries which have high deviations above the target. So if the greater is the experience, the better is regulatory and political quality, the lower are deviations above. But it has no statistically insignificant effect on the deviations below the target. What about central bank transparency? It seems that transparency cannot actually help us to reduce the upward deviations. It's more important for periods when we undershoot inflation target. And when it comes to central bank independence, then the picture is very counterintuitive, because we see here that the higher central bank independence, then the greater are deviations both upward and downward. And this is actually what I was talking about de facto and de jure independence. And we can make a conclusion that basically central bank independence is not enough when the general level of regulatory quality and political stability is low. So let me conclude. So are we on target? Do we perform well? So generally, yes. In the medium term, average inflation rates are very close to targets. Of course, we allow for short-term deviations. And our policy design seems to matter. Lower trend inflation reduces inflation volatility, which is not surprisingly, we know it all from the literature, both empirical and theoretical. But the higher is the inflation target, the more, if we tolerate higher inflation in the economy, we will induce upward deviations from the target. We will not to be able to keep inflation on the target. And widening the target band does not guarantee that it will stay in it, right? So now another question is, why should we gap these higher targets if we cannot hit them precisely? And in terms of institutional quality, yes, it works. Central banks' consistency and transparency reduce inflation, but it's asymmetric. It's not every time, and it depends on the type of deviations of inflation from the target. And in terms of central bank independence, it seems that central banks should not be strangers among their own. So it is important to have a generally higher level of institutional quality in the economy in order for a central bank to be able to gain the trust and to be able to keep inflation on target. So this is all what I have to say for today. I'm happy to hear your questions. Thank you very much.
Thank you, Alexander, for this excellent presentation. So after an encouraging case study focus on Peru, we got actually quite encouraging empirical evidence from you based on a broad range of inflation targeting countries. That's quite nice results. So thanks, and I open the floor for questions. So far, I cannot see any question in the chat. So let us wait for a while. I actually find it quite interesting, this finding on central bank independence and this potential difference between de jure and de facto. It was also interesting for me to see in your chart that for the emerging markets, the de jure independence tended to decrease over time after the introduction of inflation targeting. Do you have some explanation for this? Is it, for example, a kind of sign that legally independence went down, but maybe there was some convergence of de facto and de jure for those countries?
Well, if you look at the separate countries, you will hardly find a case when legal independence goes down, There were a couple of cases, but I don't even remember the names of this country. So if you see this average reduces with time, this is only because we have less and less countries which have this longer and longer experience, right? So basically, this is not where we should draw the conclusions. The idea is that at the beginning of the inflation targeting, emerging markets have already relatively higher central bank independence compared to advanced world, right? So this is not about independence itself. This is about how can we use this independence in reality.
Okay, so this was a kind of composition effect of the chart, not something really happening. Okay, do we have some more questions? I still cannot see anything in the chat or the question box. So if not, I will thank you, Alexander, for now. And
very much.
Thank you. And we can move to our third speaker. Basically, after the empirical experience, we are moving towards model-based papers, at least guessing from the titles. And the next speaker will be Mihai Kopacsiu from the National Bank of Hungary, and his speech will be on inflation targeting in Romania through the lens of a DSG model. So please, Mihai, the floor is yours.
Thank you, Tomasz. Hello, everyone. I hope you can hear me well. Good afternoon, and thank you for inviting me. So I'm going to present you today our experience at the National Bank of Romania with developing and using a DSG model in an IT framework that we started in 2005, August 2005, with the help also of our colleagues from the Czech National Bank, which we thank once again for it. Just to share my presentation. Just. Can you see it? Because can you see it now?
Yes, I can see it.
Oh, okay, so that's good. So this is joint work with my colleagues, Cristian Bulete from the bank and Valerian Alban, which at this point is at IMF, and the usual disclaimer applies that the views are ours and do not necessarily reflect the views of the National Bank of Romania nor the IMF. Now, this is the outline of the presentation. I will skip parts of it because of the time constraint. And in terms of motivation, besides the need to have this new structural state-of-the-art model, there were some other empirical and theoretical facts that made us choose the modeling approach that I'm going to show you. And one of them is the existence prior to the financial crisis of high currency mismatches in Romania. And you see that Romania stands out. This is a measure in index of financial of currency mismatches developed by RANSI at IMF. And the result for Romania comes mostly from the presence of unhedged borrowers. So this is one motivation. The second is basically the existence of a negative relationship between the dollarization or euroization. I will use them interchangeably, but it's euroization. In Romania, it's euroization that is the or was the problem, less now. So a negative relationship between the euroization degree and before the crisis and the real GDP adjustment during the crisis. And this is also was researched empirically by some others as Kitsu from the ECB. Last but not least, we looked at the effects of currency depreciation using some BVARs, and we saw that the effects of a currency depreciations for Romania are contractionary, as you can see here, with investment falling and GDP falling. So the falling GDP is driven mostly by investment. Even more, once you add to this BVAR also the euroization degree, namely the share of foreign currency loans in total loans, the impact is even larger. And you see that this is the difference between the BVAR where you don't have the euroization and the BVAR where you have the euroization. So it's higher when euroization is taken into account. Last but not least, we have some theoretical reasons to go in this way, and I summarize here these approaches by looking at two quotes, the most important one being the one of Tovar, which basically says that for emerging market economies, you have to take into account the possibility that the depreciation is contractionary, and due to the presence of balance sheet effects, and consequently, you have to develop models that could lead to such a result. Now, what is our contribution? Briefly, so we add this new way of introducing the dollarization in a rather classical Bernanke-Gettler Gilchrist framework. We use this model for 6 years already for quarterly analysis and forecasting at the bank to inform our results. And also since 2016, the model, a simplified version of the model, is used as a study case at the IMF course on monetary and fiscal policy analysis with ESG models. In terms of findings, besides doing pretty well in fitting this extremely volatile data that you are used with for emerging economies, with around half of, at the time in 2015, when the first estimation of the model was performed, with around half of the loans to non-financial corporations being granted in foreign currency, mostly in euros, and to mostly unhedged borrowers, we find that a depreciation of the currency relative to euro due to an increase in the risk premium generates a contraction, with negative balance sheet effects outweighing the positive ones on net exports. And we find that the effects are increasing with the degree of loan dollarization. Second, we find that domestic monetary policy is less efficient, and we see what this means. Maybe I should have put some codes there. The more dollarized the economy is, moreover, dollarization increases following an increase in the domestic interest rate. Last but not least, using our modeling of the external sector, we find that divergent monetary policy abroad might have a positive impact on output depending on the degree of dollarization. Now, I will skip this literature review just to mention that there is extensive empirical evidence, micro-based, on the negative effects of depreciation on different corporate indicators like investment, sales, profits, and share prices, and that in other general equilibrium models based on Bernanke-Gettler-Gilchrist approach for small open economies that assume full liability dollarizations, the results that are usually found is that the presence of these financial frictions approach in the presence of balance sheets magnifies the real and the financial volatility. Now, our starting point was the model of Cristiano, Trabant, and Valentin, a small open economy with financial accelerator a la Bernanke-Gettler-Gilchrist, some search and matching approach for the labor market, Gettler, Sala, Trigari. And what we try to do, we try to incorporate some features and to adapt it to the Romanian economy. The most important, as I said, being take into account the partial euroization, around half of the loans to non-financial corporations being given in euros, and to model a bit more extensively, let's call it this way, the external sector, where we looked at two economies, Eurozone and the US, as a proxy for the rest of the world, based on the currency invoice structure of Romania's external trade. Now, this is how we did that. This is our model. I will just give you some hints on the idea. So you have here the final goods producers and the final goods that are being produced. So you have consumption, government, exports, and investment. These goods are produced using imports. Can you see my pointer also on the? Okay, that's good.
Yes.
Thank you. So these goods are produced using imports and domestic intermediate goods. The latter are produced using capital and labor services and oil, imported oil. So it's not really domestic, but we kept this. Now, Then these final goods are provided to the government goods, the exports to the external sector, the consumption goods to the households, and the investment to the capital producers. You can see here that you already have, this is like the GDP part on the expenditure side of the model. And here you have a value added in the economy on the supply side, where you can recover also we see the GDP also in terms of income components. Now on the financial side, you have the classical, what we call DC, domestic currency, Bernanke, Gettler, Gilchrist approach, which these entrepreneurs, they have certain net worth. They take loans from the banks, depending on their net worth. Now, with these loans and their net worth, they are buying some capital from the capital producers. They are setting the utilization rate of the capital, and the capital services that are resulting are provided to the domestic intermediate goods producers. Now, this is a way. Now, what we are doing here, basically, we are adding another category of entrepreneurs that are borrowing in foreign currency. These guys are borrowing in foreign currency from the banks, and then they use this in the same approach. They use these funds and their net worth to buy capital from capital producers and so on. But the idea is that these entrepreneurs are subject to balance sheet effects. Now imagine that you have an increase in the risk premium. These guys are hit hardly. You have an increase in the spreads, an increase in the bankruptcy rates, and a deterioration of the net worth. If you have a deterioration of the net worth, then the demand of loans is going down. Once the demand of loans and the net worth is going down, also the demand for capital from the capital producer is going down. Now, the capital producers, if the demand for their capital is going down, also they will ask for less investment goods. Now, if the demand for investment goods is going down, also the demand of imported investment goods, but also domestic intermediate goods is going down. If this demand of domestic intermediate goods is going down, then also the demand of capital services is going down from the entrepreneurs. And you have this financial accelerator mechanism kicking in and perpetuating. But so our novelty, let's say, was to introduce this type of entrepreneurs, and we calibrate their shares such that to match this dollarization degree, loan dollarization degree in the economy. Now, for the external sector, we have like three equations model for the US and the euro area, and UIP for the euro USD interest rate, and an exogenous process for the oil in dollars. Now, what should be pointed out here is that while trade flows are taking place both in euros and in dollars, with the shares given by the currency invoice of the Romanian exports, which is exports and imports, which is around 3/4 in euros and 1/4 in dollars, the financial flows are taking place only in euro. So the UIP is basically in euro. Now we estimate this model, we re-estimate it annually. I will skip this part and let's see the results. So one result, what we are doing here, what I'm going to present you, I'm going to present you the impulse response functions from the baseline model estimated, which is the one with the dark blue, and is the case for Romania, and it's called Euroization Romania. Now, which is around 50% Euroization of the loans. With light dotted blue, you see low Euroization, which corresponds to around 10% of the loans in euros. And with red, you see the high Euroization part, which corresponds to around 90% of the loans being given in euros. Now, what you can see in terms of the results, as you can see, the inflation falls here, and the result of inflation falling comes from the decrease in the real marginal costs because of a decrease in the rental rate of capital and the decrease of wages, but and also from the exchange rate appreciation following the increase in the interest rate, in the domestic interest rate. And you can see that it slightly decreases a bit more the more euroized the economy, the less euroized the economy. So the light blue line is slightly below the blue one and the red one. But for the GDP, if you are looking at following a monetary policy increase, the GDP decreases more the less eurized the economy is. And this result is driven mostly by the investment. Yeah, this is the component where our balance sheet effects are kicking in, but here are not exactly the balance sheets, are basically the evolution of the net worth for the guys that are borrowing in euros that are hardly hit by the increase in the domestic interest rate, with some additional impact because we are having also in the models on that deflation channel. I didn't mention that because disinflation, the resulting disinflation you see here increases the real value of that. So here the fall in investment is driven by the domestic RON, domestic currency entrepreneurs being hit. Now, for the entrepreneurs borrowing in foreign currency, the impact of that deflation channel in 2 out of 3 cases is outweighed by the appreciation you see of the exchange rate and the improvement in the risk premium. So these guys are well, let's say, an increase in the interest rate favors them in a net manner. However, if you're looking overall, the results are driven mostly by what happens for the guys that are borrowing in domestic currency. Now, as I said, what you see is that the impact on the GDP is driven by investment. So investment, the more falls the investment, the more falls the GDP. What should be pointed out is something rather interesting, that at least for some initial periods, the ratio, this is what we call like the euroization degree, which is the ratio of foreign currency to domestic currency loans, increases, is higher, the higher is the euroization. Yeah. So this is one shock that we are looking at, the domestic monetary policy. Now, for the second shock, we have a risk premium, a sovereign risk premium shock. Now, if we are looking at this shock, what we are seeing usually, if you are looking at models for small open economies without balance sheet effects, what you see following a depreciation, you see an increase in the net exports that basically outweighs the eventual drop in consumption and investment, and you have an increase in GDP. This is not the case. So in our case, a depreciation induced by an increase in the risk premium is contractionary. The GDP falls. And the GDP falls more, the more euroized is the economy, because the balance sheet effects are present, and the higher is the share of the guys that are affected by the balance sheet effects. Again, the higher is the impact on investment through the evolution of net worth, and then the higher is the impact on the GDP. You see here that also you have an impact of consumption, because the currency depreciation that results from the increase in the risk premium prompts a reaction from the domestic monetary policy. So these guys that are borrowing in domestic currency are also affected, these entrepreneurs, but the increase in the interest rate also affects the consumption. So you have also a drop in consumption. But the results in terms of GDP are driven again mostly by investment, and the drop is higher, the higher is the euroization degree. And again, after a depreciation of the currency, what you see is that the euroization decreases, and the decrease is higher the more euroized is the economy. Now, what we did here, we did, given the external sector modeling, we did a simple exercise. We said, let's do an exercise where Euribor and the federal funds rate, they move in different directions. So what we are doing here, we simulate an increase in the federal funds rate and a decrease in Euribor by 25 basis points. So the results briefly here is that an economy in our model, at least, the more, and here when I'm saying euroized, it shouldn't be synonym again with dollarized, but the more loans you have in euro, yeah, the more you will benefit when ECB is expansionary, you see? So the more euroized you are, the more you will benefit in terms of GDP growth when the ECB is expansionary. Now, for a dollarized economy where loans are exactly in dollars, with the same experiment taking place, ECB being expansionary, the Fed being contractionary, what you would have seen this graph reverse in the negative values, meaning that the more dollarized the economy is, you are hurt when the Fed moves. Now, I will just go from the theoretical facts from the day-by-day usage. We are using this model quarterly as a complement for the QPM at the bank. And it helps us with many stuff, with some structural interpretation, with some alternative and counterfactual scenarios. And I'm proud to say that we made it so effective that it can be run by one person only. And over the last 2 years, I think I have to mention that was my colleague Christian that is attending the conference also. And I thank him. So here are some facts that we found over the time that are not working pretty well. And for example, that the model is doing pretty well in terms of medium-term inflation forecasting relative to QPM, but less so in terms of GDP, because when we estimated the model, some parameters were such estimated to match the highly volatile data, and you have low persistence, and the model returns pretty fast in terms of GDP forecasting to the steady state growth rate. Now, just to show you some other stuff that we are looking at, so this is the output gap, the yearly output gap. We can decompose it in the model and tell some stories here that it was driven, for example, mostly by consumption. And this is the GDP on the expenditure approach, as I told you, but we have a similar decomposition, and it's exactly the same measure of the output gap, but you can decompose it also in terms of income side of the GDP, and you see here that was driven by labor, and you had an adjustment in the profits that were dragging down. So somehow it matches our story, and it helps us in putting a good story towards the MPC. Last but not least, and I will conclude with these 2 slides, we can look at the shock decomposition. And here I group the shocks in like 4 categories, mainly demand, supply, monetary policy, and external. And you can look, for example, that the boom in the previous crisis was driven mostly by demand shocks, but also by the adjustment was mostly by some demand shocks. While if you are looking at the current crisis, you see there is a debate. What was it? Was it supply? Was it demand? In our case was, let's say, supply and demand in this order, while the recovery in 2021, I put these figures with some near-term forecast also to have the figures for this year, is driven mostly by demand. And the similar stuff you can do for inflation. Now, for example, here we had some cut in taxes in the VAT. You see that there were some supply sides accounting for inflation being well below the target, while, for example, in this year, the surge in inflation was mostly driven by some external factors. Okay, I'm not commenting on the monetary policy shocks. I think in terms of inflation, everybody in this room and probably are seeing some positive monetary policy shocks if they're trying at this stage, with the interest rates being still low, if they're trying to do an inflation decomposition in terms of using such models. So these are the conclusions. I already mentioned them. I would like to thank you once again for giving me the opportunity to present our results. And I'm happy to take any questions now. Thank you very much.
Thank you very much, Mihai, for an excellent presentation. I have here already one question from Hakan Kara. He thanks you for an extremely useful job. And well, let me find a question. According to your model, what would be the optimal response to an increase in the risk premium under very high euroization? So should you cut or hike interest rates, given that there are some perverse effects with the euroization?
Okay, I mean, if we are looking at the impulse response functions, when you have this, so it's an increase in the risk premium. So when you have an increase in the risk premium, the model basically tells you that you should, the more euroized you are, the higher should be the response of the domestic interest rate. but then basically you are somehow also the response in terms of GDP adjustment is higher. And this is related to something that I said before and was mentioned also in the previous sections, that I think in the presence of Euroization, you need some other tools. I mean, either being macroprudential, either doing something like what we are doing, and we are doing kind of flexible. We said that it's not a flexible exchange rate. What we have is a managed float and some other macroprudential measures to discourage or to counteract the possible effects of depreciation. So it's pretty hard to say. I mean, because the higher is the Euroization, your monetary policy somehow introduces more volatility from my point of view. So.
Okay, thank you very much, Mihai. One question from my side. In your model, are the impulse responses to the shock symmetric? Because in some models with financial imperfections, you may have asymmetric responses to a currency depreciation versus currency appreciation, depending on whether credit constraint become binding or not. My understanding is that your model is probably linear.
Yeah. So it's Bernanke-Gettler because you don't have collateral constraints and occasionally binding collateral constraints in the model. So what we get, it's symmetric. Yeah.
Okay, thank you very much. And one more question from my side. I understand that you model corporate balance sheet mismatches, but in some countries, especially in the Central European region, there was also an issue of household balance sheet mismatches, a lot of foreign exchange mortgages, especially in Hungary and Poland. So I wonder whether this was also the case of Romania.
It was, you're right. It was. So we took this measure because the mechanism inside the model through which this, although, okay, you can say this, the entrepreneurs are, I mean, purely, if you're looking purely theoretical, it goes through investment and through entrepreneurs, then you should say you should look only at the corporate. But also, I mean, you can think of these entrepreneurs as being owned also by households. And then you can use a more appropriate, let's say, a more economy-wide measure of a loan Euroization. Now, what happens in terms of Euroization, at least or mostly for the households, is that it decreased a lot over the last 6 to 7 years in Romania. And this was, let's say, induced also by some macroprudential measures, but also some administrative measures taken by the government. So, for example, if there were some programs to take loans for if you are buying the first house with some subsidies from the government, some guarantees of the loans from the government, full guarantees of the loans from the government to the bank, you could take it in euro. Now, over the last 6 to 7 years, most of the mortgage loans were in this program, and in, I think, 2013, 2014, it was changed such that you cannot get a government guarantee for a loan that you take in euro. You get one for a loan that you take in domestic currency only. So that led to a decrease in it was one factor, but an important one for a decrease in Euroization.
Okay, thank you very much, Mihai. I can see the questions in the chat, and we are running a little bit out of time. So I will go to the last speaker of this session, which is Michel Gassibe from the National Bank of Ukraine, a paper entitled Optimal Inflation Target for Ukraine, a Model-Based Perspective. So please, Michel, the floor is yours.
Can you hear me and see me?
Yes, perfect. And we can also see your slide.
Let me check the moving. Yes, great. So thanks a lot to the organizers for putting together this great workshop. It's a pleasure to present here. And what I'm going to do just now is to give you some current work that I've been doing concerning precisely the question of not just inflation targeting or not, but if it's inflation targeting, what level of inflation should a central bank target in the case of Ukraine? So something has been discussed a lot today, that the move to inflation targeting has been quite widespread across a lot of countries all over the world. Inflation targets vary, but one thing you do notice is that it's very often, above zero and quite substantially above zero. And from a perspective of a macroeconomist like me, this may seem a bit puzzling at first, because actually when you consider your standard sticky price macroeconomic model in which the central bank has the full power to move the nominal interest rate around, the optimal target is zero. Because under sticky prices, the central bank always wants to eliminate any dispersion in prices by making sure that those who do get the chance to adjust prices, adjust by just as much as those who do not get the chance to adjust prices. And by maintaining prices strictly fixed, you eliminate this price dispersion. So this kind of a first pass mismatch is something which interests me and a lot of other researchers recently. But actually, when you look at the sticky price models with a more realistic central bank policy space, which is the one in which it is constrained by some notion of a lower bound, a positive target emerges as the optimal response. Why? Because on the one hand, by raising the inflation target above zero, you are creating all of these price dispersion, which in turn creates inefficient allocation of resources, which is welfare deteriorating. So that's bad. But the good news is that as you increase the inflation target, you're also lowering the probability of hitting this effective lower bound. And this trade-off between creating distortions and minimizing the probability of hitting the lower bound is what ultimately pins down the positive inflation target. And actually, although this may seem like a very stylized theoretical argument, when you put these trade-offs in a standard macroeconomic model for a developed country, you actually do get something very close to 2%, which is the level of inflation target most developed economies aiming at. And the very influential paper by Koibyonga, Rinchenko, and Wieland has arrived at exactly this conclusion, that the 2% target you see for a lot of developed countries is exactly justified by this basic trade-off. But of course, the question is to quantify this trade-off properly in the context of an emerging economy, which has been the topic of this event. You need to take a lot more seriously the idea that the sort of shocks that may be driving the business cycle of emerging economy are probably quite different from the shocks driving a developed country economy. In particular, the seminal, influential Koibyonga, Rinchenko, Wieland study for the US considers a closed economy, which is only hit by technology risk premium, government spending, and markup shocks. But if you want to try and quantify this trade-off for Ukraine, you got to take foreign shocks a lot more seriously, because not just Ukraine, but a lot of emerging countries are much more open to foreign disturbances. And this is what I do in this paper, to quantify the effect, the trade-off, and to pin down the optimal inflation target for a small open economy and then calibrate it for Ukraine. So we're going to begin with a very stylized or tractable small open economy in Keynesian model, where households, choose consumption and labor subject to a budget constraint, which is very standard. The only thing I want to point out is that there is a risk premium Q on the domestic assets held by households, and this risk premium follows an AR1 process, allowing for an exogenous risk premium shock. Then, as is standard in all of these models, households' total consumption is an aggregator over consumption of domestically produced goods and foreign produced goods, with alpha pinning down the relative preference for imports. And then you have the standard downward sloping demand functions for domestically produced and foreign produced goods. On the firm side, there are two types of firms, the producers and the importers. So the aim of producers is to hire labor domestically, produce some output, and then either sell this output domestically or export this output to the rest of the world. So all of these producers have access to a linear production technology, linear in labor, where the total factor productivity or labor productivity in this case follows an AR1 process, allowing for technology shock. And then because labor is the only factor of production in this model, the total cost of production becomes W, the wage times this amount of labor. And then you can easily see that the total cost, or the marginal cost in this case, would just be the nominal wage over productivity. And then on top of that, I allow for some cost push shock process, which is isomorphic to a payroll tax. But you can think about this cost push wedge representing all sorts of unexpected costs that may be faced by an open economy firms, like some unexpected fines levied by the government, some sort of administrative costs and so on, which are proportional to the amount of labor that you employ. So these cost push wedge captures tractably all of these disturbances that directly increase your costs in a manner which is proportional to the amount of labor that you use. And then, given this marginal cost, they need to set prices so they're monopolistically competitive. And then to make some role for monetary policy, you need to introduce price stickiness. And I do this in the standard Calvo fashion, where in any period, only a randomly selected fraction of firms gets to adjust prices, and the rest are stuck at last period's level. And the parameter capturing that is theta. So in any period, the randomly selected fraction theta of firms does not get to adjust prices. So those were the producers. Then you have the importers, whose aim is to buy imported goods at the border and resell that to domestic customers. So in a sense, the cost of production is the border price of imports. So the total cost or total cost per unit bought in domestic currency is a nominal exchange rate times the exogenous import price. But then they need to resell that to my domestic customers somehow. There are many assumptions you can make about the pricing process. Today, I'll just assume that they're perfectly competitive. So they sell the imported goods at the price at which they bought it at the border. I mean, you can, in the paper, you can actually make this more complicated, allow for lotteries, like for producers, to allow for incomplete exchange rate pass-through and so on. But that's the basic idea. This is just what I said. So there are these two types of firms. Then the government consists of a central bank and a fiscal authority. So the central bank follows an interest rate Taylor rule, which has some inertial component, given extensive evidence that there's inertia in interest rate setting. And then the non-inertial component responds to some deviations of inflation from target and some deviations from output from its steady state level. And finally, I allow for some monetary shock coming from some unexpected movements from the perspective of private agents. So this is the interest rate rule that you would get if the central bank basically faced no restriction coming from various lower bounds. But in reality, for example, as long as you have cash, in the economy, you'd have trouble lowering this below zero, right? Because at that point, people prefer cash, and you lose control of your business cycle at that point. So one kind of tractable way to capture that is to say that the actual rate which the central bank gets to kind of set is some maximum between this unrestricted interest rate and some bound iota. So very often this iota is considered to be zero. So you have a literal zero lower bound. But actually in the context of emerging economies, and given some discussions we had with colleagues, you can think of this iota being positive in the case of an emerging economy. Because as you approach some very low level of nominal rates, this may deliver very low profitability of your banking system, for example, which may prevent you from going that low. But I abstract from those kind of considerations in this model, and you can just capture that in a reduced form way by having some bound iota. So that's the central bank in my model. And then you also have the fiscal authority, which collects some lump sum taxes to finance its exogenous consumption, G. And this G goes straight into the goods market clearing condition, such that the total supply in your economy, Y, has to go to either domestic consumers, to foreign consumers, so it is exported, or it's gone to your domestic government. And then this government spending follows an exogenous process where this epsilon captures unexpected changes in government spending, some unexpected aspects of the budget plan or something of that sort. So that's the kind of model in a nutshell. So it's a standard small open economy model with certain features added to it, most importantly, the zero lower bound or the effective lower bound in the nominal. So now we need to calibrate this model for Ukraine somehow. So some parameters here are less standard than others. And I'll start with the less standard ones before proceeding to the more standard ones. So the first non-standard parameter is this elasticity of substitution between home and foreign consumption goods, which is ETA, which enters your consumption aggregator. So you have to calibrate that somehow. And the way I do this is I look at the demand schedule for imported goods, which has this foreign consumption chain in front of it, and then just falls in the price of imports. And if you just take logs from both sides, you see that the log of the share of total consumption expenditure, which goes to imports, has some intercept term, and then is a function of log of the relative price of imports to the CPI. And then this object you can directly actually see in national account. So you can look at imports, and you also can look at the relative deflators of imports and CPI. And then you can just directly run this regression to recover the coefficient on the relative prices, which would then allow you to pin down the elasticity of substitution. After you do that, you see that the coefficient on the relative prices is 0.5, which then means that this elasticity is also 0.5, or in other words, in the context of Ukraine, imported goods and domestically produced goods are complements and not substitutes. So Ukrainians are not picking between domestic cars and foreign cars. They're just buying foreign produced cars and domestically produced bread. That's what this kind of roughly means in this context. Then you need to approximate this rest of the world economy, right? So sorry. You need to approximate the rest of the world economy somehow. And here I approximate the rest of the world with the EU because it's the single biggest trading partner for Ukraine. And in particular, you need to approximate two processes for the rest of the world. You need to approximate the foreign demand and foreign inflation. And I just fit simple AR1 processes for EU GDP and EU inflation, which then gives me that it's very persistent on the output side, not so persistent on the inflation side, and gives me the standard deviations of shocks to foreign demand and foreign inflation. Then I also need to say something about the Taylor rule. So I look at the Ukrainian quarterly macro data, so since the introduction of inflation targeting, and with that I can directly estimate the Taylor interest rate rule for Ukraine. And then, because I know that in my model coefficients on inflation deviation from target and the output deviation from steady state are some composites of long-run responses of inflation and the persistence parameters, I can recover from these estimates the implied long-run responses to inflation and output deviation from steady state. And you see that the long-run response to inflation is 1.45, which is above 1, which means in that period, Ukraine was following the Taylor principle, so was responding to inflation sufficiently aggressively. And then you have also got some standard deviation on the monetary shock. Two final bits is I need to fit the government spending process, which I would do with simple national accounts data to get the persistence parameter and the standard deviation of the spending shock. And then I use Ukrainian bank level data on interest rates charged to households or which you lend to households to estimate the risk premium faced by domestic households, both its persistence and the standard deviation of the shock. So those are the main parameters that I need to calibrate this model. And so the final two things, the technology and cost push processes, they're just kind of the residual ones, which are calibrated to match the observed persistence of inflation and output gap. I mean, I wish we had better data on technology to calibrate it directly, but unfortunately we don't have that. So I need to use just them as residual processes. So some final parameters, most of which are just taken directly from the literature. So the input share is 0.35, which is just internal NBU calculations. First elasticity of labor supply of 1, which is just a standard number in the literature. I don't think there's any particular studies for Ukraine on that. The caliber parameter, or the fraction of firms that do not get to adjust prices, is very crucial for the cost of inflation in these models. But unfortunately, we don't have good studies in Ukraine on that. Well, it's actually something we're working on currently with colleagues at the bank. So I've just taken the parameter used by Cobion and co-authors in the US, not because I think that's the most accurate number for Ukraine, but because when we compare the optimal target for Ukraine with the ones for the US, I don't want the difference to be driven by these arbitrary choices. So all of these differences, I want to be driven by actual estimates for Ukraine. And similarly for the within sector elasticities. I've just taken it from the Cobion paper. And finally, the discount factor, it's 0.995, so that in the steady state, you get a real rate of 2%, which comes from the paper by Gru, Lepushinsky, and Nikolai. So that's the calibration. And then, having calibrated the model, what I do is I simulate it for a certain number of periods and the different levels of the inflation target, ranging from 0 to 6%, and just measure your average expected per period utility of the household. And this is how welfare rank the different inflation targets. And once you do that, you see that in terms of welfare, as long as the inflation target is somewhere, between 1 and 3%, increasing the inflation target raises your welfare, in a sense that the benefits of not hitting the zero lower bound as often outweigh the extra price dispersion and productive distortions that you create, up until the value of just above 3. After which, after about 3%, the welfare cost of these distortions created by price dispersion at high inflation outweighs the cost of not hitting the zero lower bound, because actually around here, after 3%, you're never hitting the zero lower bound, and you're just creating extra distortions with higher inflation target, which suggests that the optimal inflation target for Ukraine is just above 3%, compared to about 5%. Which is the target right now. And of course, those are just my personal views and not the official position of the bank. So just to put this in perspective, the US target, which would come out of the similar exercise with US data, which is the Younger-Renchenko-Wieland paper, is just below 2%. And because we've calibrated the kind of parameters, keeping some of them the same, most of this gap is driven by different basic volatility of the economy by adding foreign shocks and having technology and markup shocks as more volatile, which is what drives the difference. So some extra exercises I do in the paper is I want to think about some kind of the effect of some secular trends on the optimal inflation target. So in particular, I vary the price stickiness parameter for one reason or another. For example, the economy becomes more competitive, or you enter the IT age where more things are traded online with more flexible prices. And I want to investigate the effect of that on the inflation target. So for example, as the price stickiness decreases to about 0.5, the optimal target rises to about 3.3. So that's the sort of slope we're talking about. So for 0.05 decrease in the caliber parameter, the optimal target rises by about 0.3, which comes from the idea that as prices become less sticky, the gap for a given inflation rate, sort of the inflation becomes less costly. because you don't get as much dispersion between adjusters and non-adjusters. And of course, the other way around, if you increase the Calvo parameter, so the economy is more price sticky, the optimal target becomes lower, because it's now, inflation becomes costlier much faster as you increase the inflation target. Another exercise, which is very relevant in the case of Ukraine, it comes from these secular changes in the steady state real rate. So for example, you hear the discussion in the context of Japan very often, that aging population and these demographic trends have the propensity to lower your steady state interest rate, because you have way more sort of old people who are saving and not much young people who are borrowing. And I want to see what happens as this long run steady state real rate changes. So for example, if you move from the baseline value of 2%, which is a very recent estimate for Ukraine, to a 1.5%, this increases the optimal target almost to 3.5, so almost by 0.5 percentage points. Why? Because as these demographic trends, for example, lower your steady state real rate, your nominal rate more or less fluctuates around the lower value for a given level of inflation target, such that to shield yourself from the possibility of hitting the lower bound, you need to impose a higher target, given these secular trends. And of course, the opposite would happen if you had some secular trends increasing your steady state real rate. So the optimal target would fall in that case. So those are the sort of exercises I also do in the paper. And then, so I want to think about this project as an evolving model which can be updated in light of more micro evidence, in particular on the behavior of prices in Ukraine, which is why I actually think some of these estimates are on the conservative side. In particular, so we assume time-dependent probabilities of price adjustment, Calvo, which could be a good approximation for an economy hit by small shocks, right? But that's probably not the case in Ukraine. And, probably a more realistic pricing structure here, which would capture the possibility of getting hit by large shock accurately, would feature a notion of venue cost or some other, state-dependent probability of price adjustment. And we know from some recent work in the US that once you replace Calvo with menu cost, as is done in this AJ macro paper by Blanco, the inflation target tends to increase. So I'm not saying it's going to double as well in the case of Ukraine, but it's probably going to increase somewhat once you do a more realistic menu cost pricing frictions. But for that, we need wealth of microdata for Ukraine, which is actually something we're working on with colleagues right now. And then another kind of simplifying assumption here has been the assumption of a homogeneous labor market with no mobility frictions. So because it's so easy for people to move across different firms in this economy, so you can switch from being a football player to being a singer to being a central banker very easily in this model. This actually amplifies the cost of inflation, because any of these price dispersions created by inflation, they create inefficient allocation of labor across firms. And if you restricted people from moving across firms as much, some of these inefficient allocations of labor will be attenuated, which would lower the cost of inflation and probably deliver a slightly higher target. But to properly calibrate kind of these mobility frictions, you need, again, much better microdata on labor market mobility in Ukraine. So it's something we'd also want to. But as I said, with more microdata, we can do a lot more. But that's it for me from now. So in this paper, I've quantified the trade-off between not hitting the zero lower bound and creating distortions as coming from an inflation target above zero. And I pinned down it for Ukraine in the context of this model, and current work involves using microdata for Ukraine. Thank you.
Thank you very much, Michel, for a very interesting presentation. Actually, in the Czech Republic, there are some colleagues of mine from the academia who argue that our 2% inflation targeting is too high and that we should actually focus on zero inflation as the concept of price stability. And I always suspected that they are neglecting in their thoughts the zero lower bound issue. And it's very nice to see that you've taken this into account and that you've arrived at a sensible conclusion. So it will be my pleasure in the future to refer to your paper in those debates with my colleagues.
Oh, definitely. I mean, I'd be happy to, discuss it further if needed.
Perfect, perfect. Thanks. Thank you very much. For the moment, I don't see any questions in the chat. So I open the floor. We are already running over time. I'm sorry for that. I'm a bad moderator, but all the speakers did a marvelous job in presenting the things nicely. So do we have any questions? Maybe from my side, who sets inflation target in Ukraine? Is it the central bank itself, or is it some role of government in this process?
So I think I've lost you for a second, but the question was who sets the inflation target?
In Ukraine, yeah.
I believe that's some, I mean, I may be wrong about this. There may be colleagues who know this better, but I believe this is some form of an internal process at the bank. So although there may be some, yeah, I think that's right. But I'm not sure it's done directly by the equivalent of the Monetary Policy Committee, but I think it's some kind of internal process.
Let me answer here.
Yeah, actually, you definitely know much better than I do.
Yeah, a little bit. Yeah, in our case, the targets are set by the NBU Council. So that is not the board which takes decisions on the interest rate, like in the Czech case, very similar to the Czech case. But we have supervisory body council which sets the targets for the board.
Okay, thank you very much, Sergey. And because I see no further questions, maybe this is the right time to pass the floor to you for the concluding remarks. So Michel, thanks once again for a very nice presentation.
Thank you very much, Tomasz, and thank you very much to everyone who contributed to this really very insightful event, which even exceeded my high expectations. While most of us would have liked to gather in person today, I'm grateful that we are still able to connect virtually. And unfortunately, since early 2020, the COVID-19 pandemic has impacted our lives in unprecedented and profound ways. So we have had to learn to live with the disruptions and to find new ways how to work, to interact with each other. The novelty of this pandemic and crisis and the tremendous uncertainty around the evolution of this crisis made it quite unique in several dimensions. And last year, actually, it posed new challenges for policymakers to the central banks, and which dealt with acute and persistent volatility in financial markets, and also tried to contain a deep economic contraction. This year, emerging market central banks face new challenges of multi-speed economic recovery and simultaneous inflation spike with a quite high degree of uncertainty of its further development. Definitely all that creates very unique environment calling for the update of our models and analytical tools. That's actually why it's so important to gather for such discussions like today's one and look for the solutions in the areas of our responsibility. In what follows, I would like to share my personal several lessons which I learned during this workshop. The first lesson concerns a timely and decisive reaction of central bankers addressing the financial shock and risk aversion spiral to prevent the full-fledged financial crisis. And as financial shock hit during the first weeks of the pandemic, it was crucial to adopt measures to restore an orderly functioning financial markets. This time, I should say that this time the resilience of domestic financial sectors in emerging markets to adverse shocks, along with the liquidity provided by systemically important central banks, proved to be very important to stabilize financial markets. In contrast to the monetary policy response to previous crises, when most central banks of emerging markets implemented interest rate hikes in order to prevent exchange rate depreciations. This time, monetary authorities were able to reduce their rates very rapidly. And this reflects the high degree of credibility maintained by central banks and how inflation expectations have also remained quite ancient before the crisis. Even more, as I learned from this workshop, emerging market central banks were even faster than the central banks in advanced economy. And sure, the credibility gained in previous years, sometimes with very large suffering, played back. And as Alina mentioned during her speech, that cannot be overestimated. In that case, Ukraine, the central bank embarked on a series of interest rate cuts and implemented measures to provide ample liquidity to the banking system within its legal mandate to ensure their financial stability via orderly functioning domestic markets and to support the economic recovery via lending channel. Again, many central banks in emerging market universe use different measures. Some of them used unconventional monetary policy tools for the first time, embarking on government bond purchases, and in some cases undergoing necessary reforms to eliminate legal restrictions. And of course, no universal recipe exists for every case. And even though in the first phase of the crisis, central banks had to respond swiftly to avoid bad equilibriums and stabilize the markets, I believe that we should not overemphasize the so-called market maker of last resort narrative and the credibility achieved before the crisis. Because losing this credibility and suffering again in order to regain this credibility may be very painful for the central banks in emerging market world. My second lesson from the workshop is that the environment of high uncertainty, like the one associated with the inflation shock resulting from the post-pandemic recovery, a solid macroeconomic framework, including a prudent and data-based monetary policy approach, and the development of deep and liquid financial markets are essential. In the world, the conduct of monetary policy is in a very challenging mode. Incoming data seems to suggest that the global recovery might be faltering or at least losing pace. Meanwhile, inflation that grew on the back of elevated commodity prices and supply disruptions induced by pandemic. So it's huge uncertainty around the world about the nature, persistent or transitory of inflation nowadays we observe. And definitely there are a lot of concerns about the faster tightening of global financial conditions as a result of such events. The largest economies, central banks are now close to the limit of their ultra-accommodative policies pursued for many years. And if the surge in inflation is not so temporary and persists, central bank will be forced to respond. And if they tighten their policies, this will cause capital outflows from emerging markets. Rising volatility will certainly affect the economy. I heard a few times this concern during today's workshop. And in such uncertain environment, it is vital that emerging market central banks continue to ensure that monetary policy decisions contribute to orderly normalization of their policies. So, sure, a prudent and data-dependent approach, mindful of policy trade-off, is needed. In this context, a key challenge for policymakers, particularly central banks, is to respond to the crisis in a timely and decisive manner, but without affecting the resilience of both the economy and the financial markets. And as it was mentioned today a few times, the current inflation spike was badly forecast by the central banks and the markets. Given the unprecedented crisis, previously estimated economic models and coefficients were not able to allow us to accurately forecast the economy and the inflation this year. So we have to be very cautious and flexible in our policy response. Moreover, it's extremely difficult to identify the effects of the pandemic shock, that is it that short-lived or is it longer lasting. But my strong belief that even in spite of all this uncertainty, we have to discuss the calibration of our monetary reaction on inflation spike and deterioration of inflation expectations. However, we can't allow ourselves to ignore the need to react at all. And my third lesson is that we don't need to fix the current monetary policy framework. 6 years ago, the National Bank of Ukraine implemented a flexible inflation targeting regime. And I recall that 6 years ago there were a lot of pessimism widespread, both in the Ukrainian economy and also like among Ukrainian public, and also even inside the central banks. Not so many people actually believed at that time that this strategy could be very successful in the Ukrainian case. But over the period of 2015-2020, we were able to reduce the inflation from 50-60% to 5%, which was completely in line with our target. They consider it as the combination of the good luck and the good policy, but definitely monetary policy earned a credibility bonus due to this success, and we were able to ensure inflation expectation. And at the time when investors and businesses reposed confidence in Ukraine's macroeconomic. During this period, we introduced a lot of innovations into our monetary policy framework, including setting the operational design of monetary policy toolkit, streamlining a fixed intervention strategy, enhancing communications, and so on. But definitely we think that it's not fixed. We understand that the framework continues to evolve. And that's why we consider the option of reviewing the definition of the price stability. We review our monetary policy instruments and their effects, especially in the current very unstable environment, as well as our communication practices. In more long-term perspective, we are also going to assess the importance of digitalization, financial stability, globalization, climate change from the perspective of monetary policy. Needless to say that these topics continue to be important for our future research. And many of these topics were mentioned today during our workshop. Another topic and important theme for economic research and in the central bank is the interaction between the monetary policy and inequality. Today we also heard some concerns about this interaction. So let me conclude here. It is necessary to understand and learn from both the wins or target hits and mistakes, policy mistakes and targets misses. Yet, even as we seek to move forward, we are confronted with the reality of a very complex and rapidly evolving world. It is now more even ever that the central banks should turn this challenge into the new opportunity, and in order to build more exciting future, which will be definitely, from my point of view, associated with the price stability. With that in mind, thank you all again for being the part of this insightful event, and please stay safe. Bye-bye to everybody.